resources. As states scramble to pay skyrocketing unemployment claims and meet public health expenses, 1.6 million public sector employees have lost their jobs. State governments face an estimated $790 billion revenue shortfall next year. And without action, 5.3 million more public sector employees could lose their jobs. We're also facing an impending eviction crisis with 30% of renters being unable to pay their rent for June. Against this backdrop, Donald Trump has urged a premature return to business as usual and held a jobs report that showed Black unemployment rising as a, quote, he said, great day, unquote. Last month, the House passed the HEROES Act to extend assistance to states, cities, the unemployed, as well as renters and homeowners. But the Senate Republican leader has said Congress should, quote, wait and see, quote, unquote, before considering more relief. While the Trump administration has declared victory and spread dangerous misinformation, you have been a real voice of reason, cautioning that unemployment is still, quote, historically high, unquote, recognizing its disproportionate impact on communities of color and acknowledging that economic recovery will depend on public health outcomes. You have also stressed that, quote, additional fiscal support, quote, unquote, is needed to avoid long-term damage. The economy recovered unevenly from the last crisis, leaving the Fed with limited ammunition. Nevertheless, the Fed has stepped in to rescue an economy in free fall. We've seen the stock market respond, but communities of color and small businesses are reeling, and you are at the end of what you can reasonably do in terms of monetary policy to help the economy. Now is the time for strong fiscal policy from Congress in the form of the HEROES Act. Without it, I'm extremely concerned about the future of our nation's economy. With that, I yield back the balance of my time. The chair now recognizes the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes for an opening statement.
Well, thank you, Madam Chair. And Chairman Powell, welcome back before the committee. Thank you for virtually being here and for virtually taking our questions. But the circumstances are obviously much different than where we were in February when we last met. I'd like to commend you and the Federal Reserve for your activities and engagement in this unprecedented time. I believe it was the Fed's rapid and decisive action that prevented the worst effects of this economic catastrophe brought about by the coronavirus and helped stabilize the market. The Fed, as firefighter, was able to stave the flames, to contain the flames. But we know that that is not a permanent circumstance for the Federal Reserve to be in that firefighting phase. Using its 13.3 emergency lending authority, the Fed signaled to American households and to businesses that it will do everything in its power to respond to the economic crisis that resulted from this global health crisis. The Fed announced 9 lending programs to help support the proper functioning of our financial markets and our economy. Smartly done. Many of these facilities are in operation today. However, some of those facilities aren't even yet operational, but markets were calmed just by the announcement from the Fed. So I want to commend you for that decisive action in this early phase of what we know is are challenging times for the American people. I believe it must keep these facilities focused on broad-based support of our economy and ensure that they're responsive to economic conditions, not the political ones. I also want to express a point you made last week, and I believe is worth repeating. As the Fed embarks on protecting the economy through careful and targeted use of its powers, Congress must be realistic about what the Fed can and cannot do. The Fed is a lender. The Fed is a lender of last resort. It is not responsible for fiscal policy. That's Congress's action. And it is not a piggy bank to be used to fund the whims of Congress. We must ensure the Fed remains laser focused on monetary policy and not become a testing ground for ideological experiments or unproven theories. unconventional monetary proposals should be considered with utmost care, particularly ones that have had mixed records in other major economies. We should be focused on the tens of millions of Americans who remain out of work through no fault of their own. According to the Fed's economic projections, we will still be facing unprecedented unemployment for the rest of this year, for nearly twice the unemployment rate that we experienced just as recently as February. Creating an economic recovery that grows jobs must be priority number one. But the Fed cannot do this alone. The Fed cannot train workers to match them more effectively with job openings. Congress has to legislate that. Congress is responsible for enacting pro-growth policies, not the Fed. And the Fed cannot modernize our education system or change tax policy. That's Congress's role. Only Congress can legislate these policies, which is why we need bipartisan solutions to ensure that our economy remains strong and comes back stronger than ever. We should be identifying the metrics that will be used to determine the ongoing need for emergency lending as well. Chairman Powell, I urge you to continue to be forward-looking as you have been since many of us, before the public actually knew what the coronavirus was, you were taking action. And so I anticipate the challenges we face in the next 6 months or a year will be enormous, but I commend you for looking ahead. And while I hope we're through the worst, it is clear that more must be done. However, we should all keep an eye toward the aftermath and how we plan to right-size policies once again to ensure the long-term stability of our financial system. And with that, I'd like to thank you again for being here and look forward to your testimony and question. Yield back.
The chair now recognizes the chair of the National Security, International Development, and Monetary Policy Subcommittee, Mr. Cleveland, for 1 minute.
Thank you, Madam Chair. Thank you, Chairman Powell, for being here. On Sunday, the Dallas Federal Reserve President Kaplan stated, and I quote, "Systematic racism is a yoke that drags on the American economy, and a more inclusive economy will lead to a better growth." And I tend to agree with what he said. Before the pandemic, nearly 60% of Black adults were employed. COVID-19 has ravaged our nation and the low paid and frontline service sectors. Now, just less than half of Black people are employed. Economic justice is a part of social justice, and I want to examine some of these concepts with you. Economic justice would include the minimum wage increase, expand earned income tax credit, investment in education, and create a progressive tax code. So thank you for being here, and I'll explore those later. Thank you, Madam Chair.
You're welcome. The chair now recognizes the ranking member of the subcommittee, Mr. Hill, for 1 minute.
Thank you, Madam Chair. Chairman Powell, thank you for being with us virtually today. We appreciate you being responsive to all of our questions in this challenging environment. Your monetary policy report dated June 12th was an excellent, detailed recap of the extraordinary events of the past 4 months. I commend the Federal Reserve and their quick response and necessary actions taken to mitigate the harm from COVID-19. Your quick action preserved companies' access to markets and fresh capital to weather this storm. Today, members will discuss the Federal Reserve's facilities, the virus and its impact on the economy, and our citizens, many of whom are not yet back to work. I look forward as well to a discussion about monetary policy. The balance sheet has grown by nearly $3 trillion since the beginning of March. I look forward to discussing these things and again, welcome you to the committee. Yield back.
I want to welcome to the committee our distinguished witness, Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell has served on the Board of Governors since 2012 and as its chair since 2017. Chair Powell has testified before the committee, and I believe he does not need any further introduction. Without objection, your written statement will be made a part of the record. I want to remind members that Chair Powell has a hard stop and will be with us for 3 hours until 3 p.m. Eastern Time. Chair Powell, you are now recognized to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, and other members of the committee. Thank you for the opportunity to present the Federal Reserve's semi-annual monetary policy report. Our country continues to face a difficult and challenging time as the pandemic is causing tremendous hardship here in the United States and around the world. The coronavirus outbreak is, first and foremost, a public health crisis. The most important response has come from our healthcare workers. On behalf of the Federal Reserve, I want to express our sincere gratitude to these dedicated individuals who put themselves at risk day after day in service to others and to our nation. Beginning in mid-March, economic activity fell at an unprecedented speed in response to the outbreak of the virus and the measures taken to control its spread. Even after the unexpectedly positive May employment report, nearly 20 million jobs have been lost on net since February, and the reported unemployment rate has risen about 10 percentage points to 13.3%. The decline in real gross domestic product this quarter is likely to be the most severe on record. The burden of the downturn has not fallen equally on all Americans. Instead, those least able to withstand the downturn have been affected most. As discussed in the report, low-income households have experienced by far the sharpest drop in employment, while job losses of African Americans, Hispanics, and women have been greater than those of other groups. If not contained and reversed, the downturn could further widen gaps in economic well-being that the long expansion had made some progress in closing. Recently, some indicators have pointed to stabilization and in some areas a modest rebound in economic activity. With an easing of restrictions on mobility and commerce and the extension of federal loans and grants, some businesses are opening up, while stimulus checks and unemployment benefits are supporting household incomes and spending. As a result, employment moved higher in May. That said, the levels of output and employment remain far below their pre-pandemic levels, and significant uncertainty remains about the timing and strength of the recovery. Much of that economic uncertainty comes from uncertainty about the path of the disease and the effects of measures to contain it. Until the public is confident that the disease is contained, a full recovery is unlikely. Moreover, the longer the downturn lasts, the greater the potential for longer-term damage from permanent job loss and business closures. Long periods of unemployment can erode workers' skills and hurt their future job prospects. Persistent unemployment can also negate the gains made by many disadvantaged Americans during the long expansion and described to us at our Fed Listens events. The pandemic is presenting acute risks to small businesses, as discussed in the report. If a small or medium-sized business becomes insolvent because the economy recovers too slowly, we lose more than just that business. These businesses are the heart of our economy and often embody the work of generations. With weak demand and large price declines for some goods and services, such as apparel, gasoline, air travel, and hotels, consumer price inflation has dropped noticeably in recent months. But indicators of longer-term inflation expectations have remained fairly steady. As output stabilizes and the recovery moves ahead, inflation should stabilize and then gradually move up over time closer to our symmetric 2% objective. Inflation is nonetheless likely to remain below our objective for some time. The Fed's response to this extraordinary period is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We are committed to using our full range of tools to support the economy in this challenging time. In March, we quickly lowered our policy interest rate to near zero, reflecting the effects of COVID-19 on economic activity, employment, and inflation, and the heightened risks to the outlook. We expect to maintain interest rates at this level until we're confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals. We have also been taking broad and forceful actions to support the flow of credit in the economy. Since March, we've been purchasing sizable quantities of Treasury securities and agency MBS in order to support the smooth functioning of these markets, which are vital to the flow of credit in the economy. As described in the report, these purchases have helped restore orderly market conditions and have fostered more accommodative financial conditions. As market functioning has improved since the strains experienced in March, we have gradually reduced the pace of these purchases. To sustain smooth market functioning and thereby foster the effective transmission of monetary policy to the broader financial conditions, we will increase our holdings of Treasury securities and agency MBS over coming months, at least at the current pace. We will closely monitor developments, and we're prepared to adjust our plans as appropriate to support our goals. To provide stability to the financial system and support the flow of credit to households, businesses, and state and local governments, the Fed, with the approval of the Secretary of the Treasury, established 11 credit and liquidity facilities under Section 13.3 of the Federal Reserve Act. The June report provides details on these facilities, which fall broadly into two categories: stabilizing short-term funding markets and providing more direct support for credit across the economy. To help stabilize short-term funding markets, the Fed set up the Commercial Paper Funding Facility and the Money Market Liquidity Facility to stem rapid outflows from prime money market funds. The Fed also established the Primary Dealer Credit Facility, which provides loans against good collateral to primary dealers that are critical intermediaries in short-term funding markets. To more directly support the flow of credit to households, businesses, and state and local governments, the Fed established a number of facilities. To support the small business sector, we established the Paycheck Protection Program Liquidity Facility to bolster the effectiveness of the CARES Act. Our Main Street Lending Program, which is just now launching, supports lending to both small and medium-sized businesses. The Term Asset-Backed Securities Loan Facility supports lending to both businesses and consumers. To support the employment and spending of investment-grade businesses, we established 2 corporate credit facilities. And to help U.S. state and local governments manage cash flow pressures and serve their communities, we set up the Municipal Liquidity Facility. The tools that we are using under Section 13.3 authority are appropriately reserved for times of emergency. When this crisis is behind us, we will put them away. The June report reviews the implications of these tools for the Federal Reserve's balance sheet. Many of these facilities have been supported by funding from the CARES Act. We will be disclosing on a monthly basis names and details of participants in each facility, amounts borrowed and interest rate charged, and overall costs, revenues, and fees for each facility. We embrace our responsibility to the American people to be as transparent as possible, and we appreciate that the need for transparency is heightened when we're called upon to use our emergency powers. We recognize that our actions are only part of a broader public sector response. Congress's passage of the CARES Act was critical in enabling the Fed and the Treasury to establish many of the lending programs. The CARES Act and other legislation provide direct help to people, businesses, and communities. This direct support can make a critical difference, not just in helping families and businesses in a time of need, but also in limiting long-lasting damage to our economy. I'd like to end by acknowledging the tragic events that have again put a spotlight on the pain of racial justice in this country. The Federal Reserve serves the entire nation. We operate in and we're part of many of the communities across the country where Americans are grappling with and expressing themselves on issues of racial equality. I speak for my colleagues throughout the Federal Reserve System when I say there's no place at the Federal Reserve for racism, and there should be no place for it in our society. Everyone deserves the opportunity to participate fully in our society and in our economy. We understand that the work of the Fed touches communities, families, and businesses across the country. Everything we do is in service to our public mission. We're committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I look forward to our discussion.
Thank you, Chairman Powell. I recognize myself for 5 minutes for questions. Chair Powell, before you joined the Fed, you were a fellow at the Bipartisan Policy Center and an advocate of deficit reduction. So I took it seriously when you said on April 29th, and I quote, "This is the time to use the great fiscal power of the United States to do what we can to support the economy," quote unquote. On May 13th, 2 days before the House passed the HEROES Act, you reiterated this message saying, quote, additional fiscal support could be costly, but worth it if it helps avoid long-term economic damage and leaves us with a stronger recovery, quote unquote. On Sunday, Dallas Fed President Robert Kaplan seemed to echo that, saying, quote, fiscal policy is going to be critical from here, quote unquote. And yesterday, former Fed chairs Bernanke, Yellen, and more than 130 economists wrote a letter calling for a bold congressional response, including, and I quote, continued support for the unemployed, new assistance to states and localities, and investments in programs that preserve the employer-employee relationship, quote unquote. The May jobs report showed slightly better jobs numbers than the April jobs report, which was the worst in recorded history. But there's still major reasons for alarm. Black unemployment rose to 16.8%, and 600,000 public sector jobs were lost. Yet, this administration and Senate Republicans are not moving with any urgency. Republicans seem to be more focused on a more limited response while granting a broad liability shield for major corporations. Question, do you agree with your predecessors, Chair Powell? Should Congress take bold action as soon as possible, quote unquote?
Thank you, Madam Chair. So I would agree that Congress has already provided significant fiscal support, and that support is now having a positive effect on the economy. We see it in consumer spending and income data. We see it in payrolls. All of that is helping. And I would just note that there are something like 25 million people who are still who have been dislodged from their job, either in full or in part, due to the pandemic. And I would think that it would be a concern if Congress were to pull back from the support that it's providing too quickly. I wouldn't presume to prescribe exactly what you should or should not do, but I would say that it would be wise to look at ways to continue to support both people who are out of work and also smaller businesses that may not have vast resources for a continued period of time, not forever, but for a period of time, so that we can get through this critical phase. The economy is just now beginning to recover. It's a critical phase, and I think that support would be well placed at this time.
Thank you very much. On May 15th, more than a month ago now, the House passed the HEROES Act, which would, among other things, provide $175 billion in rental and homeowner assistance, nearly $1 trillion to support state, territory, and local governments, and another round of direct stimulus payments for individuals and families. I would note many states are reporting an uptick in confirmed cases of new highs, hospitalizations, with some officials slowing their effort to reopen. So who will suffer if the Senate does not promptly adopt these measures to support state and local governments, renters, homeowners, and the broader economy?
Well, as I mentioned, Madam Chair, I do think it would be appropriate to think about continuing support for people who are newly out of work and for smaller businesses who are struggling to get through what will be a temporary period as the economy moves back up toward higher levels of activity.
Thank you very much. Before moving on for the next question, I'd like to call on Ranking Member McHenry to share with us some information that is very important to this committee.
Well, Madam Chair, I'll allow you to please continue your questions. I'll take that out of my time. But well, actually, while we're here, since the technology is tough, point of personal privilege, I would seek to inform committee members about the tragic passing of our colleague and friend Andy Barr's wife, Carol, last evening. When Andy arrived home, he found that his wife had passed. They have 2 young children. She was 39 years old. This is quite a surprise and shock for all of us. But wanted to ensure that committee members know this information And please keep Andy and his two young girls in your prayers. Thanks so much, and thank you, Madam Chair. Yield back.
Thank you so very much. And now, Mr. McHenry, I will recognize you for 5 minutes for questions.
Well, thank you, Madam Chair. And look, Chairman Powell, the Chairwoman Waters, her questions about fiscal policy are certainly, I think, appropriate. We always want the Fed chair to endorse our pieces of legislation. That is commensurate with every previous Fed chair, and certainly with you as well. However, the monetary and fiscal policy are two very different things. And so I would urge you and the leadership of the Fed to stick to monetary policy. Now, your words of encouragement that we have our responsibilities on the fiscal side of the house, I think, are well noted. And what you're telling us about the employment marketplace on a going forward basis, I think, is informative for our policymaking. And so thank you for your statements there that additional congressional action is required. Now, along those lines, we have the Main Street lending facility that is to be stood up soon. So walk me through what the intention here is, because this is not something that is, and over the last 100 years, the Fed is engaged in. The intention here, and what is the missing piece that perhaps Congress should think about filling in?
Mr. McHenry, are you asking specifically about Main Street? Or
yes. So if you say the intention of the Main Street lending facility.
Okay, great. So for smaller companies, there was the Paycheck Protection Program. And for companies that have access to the bond market and are investment grade rated, we have corporate credit facilities. And then there's a large group of very important companies, very diverse, different sectors, different needs, just very different. And those are, for them, we have the Main Street facility. And our intention is that if there are creditworthy companies, to the extent there are creditworthy companies in that space who are not able to get credit from the banking system because of the pandemic, we want to be there to provide that credit. So that's what we've been working on. It's significantly different from any other undertaking we have been working on here, particularly because that space is, by definition, it's a space where commercial banks really are the key form of liquidity and of lending. And the bank credit agreements are always negotiated, so there isn't a really high level of standardization. Each one's a little bit different. So we've got to find a way to get to those borrowers, get through their credit agreements, and get them funding. And we're working through the banking system to do that. We have now registered lenders so that the facility is effectively open now. The lenders are registering, and they can now begin to make loans. We're encouraging them to do so. And those loans will soon be transferred, 95% interest in them will be transferred to the facility. So we're there. We're, as I think we've shown, as we go with all these facilities, we are learning. No one's ever done this exactly. And so we've been constantly taking feedback from lenders and borrowers, and we'll keep doing that. And that's true for all of our facilities until we feel we've got the facility that can do the best job.
Okay, so that's an unconventional set of monetary policy that you're utilizing, given the unconventional nature of this health and therefore economic crisis that we're facing. We also see other banks, Japan and Europe, trying to control inflation targets using unconventional means, such as yield curve control and negative rates. Do we have empirical evidence to support deploying these tools in the United States as you see it?
There's a split. I'd say the evidence is mixed on negative rates. There are those who believe negative rates are quite effective, and there are those who see the results as somewhat ambiguous. I think here in the United States, we've looked at it carefully. We looked at it during the long expansion that ended in February and chose not to deploy them in the United States. Lately, the FOMC has looked carefully at negative rates and continues to see pretty broadly across the committee that negative rates are not something that we think is appropriate for the U.S. economy, at least at this time. And it's not something that we see ourselves resorting to. Instead, we look at ourselves using asset purchases and forward guidance. In terms of yield curve control, as you pointed out, it's currently being used by a couple of central banks around the world. And that's just, rather than buying assets, what you're doing is you're saying, we won't let the treasury curve at a certain level move above something. And if it starts to move above that level, the rate moves above it, then we'll buy treasuries to drive the rate level back down. The United States actually did that from the late 40s into the early 50s. I'll just finish, sorry. It's something we're really just educating ourselves on at this point. It's not something we have at all decided to do.
Thank you for your testimony. And Chair Powell, I also appreciate the fact that you said when the crisis passes, we will put them away, these new tools. I think that is a very sober assessment. We need to have a return to normalcy once this crisis passes. Thank you for your leadership, and I yield back. Thank you, Chairwoman Waters.
Mr. Cleaver, you're recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, again, thank you for being here. I started out with my opening comments talking about the situation that we find ourselves in this country. And I believe that this is a moment unlike any other that I have seen in terms of the country's willingness to finally address these long-lasting issues of race and putting them aside. I spoke to a group of 5,000 demonstrators, and I was almost brought to tears when I stood up to speak because the crowd was probably 65% white, and the rest maybe brown and African. The crowd was probably 65% white, and the rest maybe brown and African. The crowd was probably 65% white, and the rest maybe brown and African. I mean, do you believe that the board can take on some of the issues of economic injustice and I may be using terminology that that's not universal, but increasing the minimum wage and expanding the earned income tax credits, things I mentioned earlier, and to try to begin to iron out, if you will, some of the wrinkles that have been around way too long. It's not even, I mean, I don't even feel great about even discussing this issue in 2020. So I see a role, but I'm just wondering if you think the Fed can play a role.
I do think we have a role, and I believe we will do our best to play that role. I wouldn't say it's the lead role, but I would say that we are definitely recommitting ourselves to enforcement of fair lending laws, as I mentioned. I would also say, just as an institution, we want to be, we've tried to make it a very high priority of diversity and inclusion. So we want to set an example for that, both internally, to some extent we, my colleagues and I have spoken out publicly on these issues, which I think is appropriate in this unusual moment. And then the last thing, and probably the most important thing we can do, is try to get back as quickly as possible to the labor market we had for the last couple of years. We want there's nothing like a tight labor market for for the lives in low and moderate income communities. We saw things we hadn't seen in 50 years, and we want to get back there. Everything we're doing with our monetary policy tools is ultimately designed to get us back to a tight labor market as quickly as we can, and then stay there. That's really the overarching goal of what we're doing.
Well, I appreciate your comments. And my questions were not meant to be accusatory. In fact, I think that the Federal Reserve, I mentioned earlier the comments of Mr. Kaplan, but even later on this week, I will be sitting down with Esther George to discuss some of these same issues. Thank you, Mr. Chairman, and thank you, Chairman Waters.
Thank you very much, Mrs. Weaver. I'm sorry, Wagner, you are recognized for 5 minutes.
Thank you, Madam Chairwoman. And I thank you, Chairman Powell, for coming before this committee today. And I wanted to commend you, as so many of our colleagues have, and the Federal Reserve for moving so very swiftly and decisively these past few months on keeping America's economy stable during this pandemic. Just this week, the Federal Reserve announced it would begin buying up to $250 billion in individual corporate bonds through the secondary market corporate credit facility, with the ability to also, I believe, tap into $25 billion in funding from the Treasury Department that was provided by the CARES Act. I understand the need for the Federal Reserve to have this facility at the ready, but I'd like to know why you decided that it was at this time to launch the facility now. What was the reasoning for launching this week?
So actually, this was something we've been saying since we first announced the facility we would do. It did happen to be the fact that we ultimately got around to doing it on Monday. And the overall goal of all of that is to support market functioning. This is the corporate credit facility, and this is the secondary market part of it. So we want to support market functioning, because when markets are working, companies can borrow, people can borrow, companies aren't feeling tons of financial stress, and they're less likely to take cost-cutting measures and things like that. So I would say a couple things. First, buying cash bonds is going to form the primary mode of support over time by which we support market function. Over time, we'll gradually move away from ETFs, not suddenly at all, and we'll move more to buying bonds. It's a better tool ultimately for supporting liquidity and market function. At the current moment, markets are functioning pretty well, so our purchases will be at the bottom end of the range that we've written down. And as those markets continue to normalize, our purchases would decline.
Chair Powell, are you planning to hold all of these bonds to maturity?
Ultimately, we are generally a hold to maturity entity. Okay. It may be that we sell some back into the secondary market down the road, but ultimately we're a buy and hold buyer.
Chairman Powell, as you know, on April 22nd, in response to a letter from Senator Crapo, the Federal Reserve Vice Chair for Supervision, Randall Quarles, requested that Congress consider modifying Section 171 of the Dodd-Frank Act, otherwise known to all of us as the Collins Amendment. Do you agree with Vice Chair Quarles that Congress should revisit the Collins Amendment to ensure that banks are able to adequately respond to increased credit demands?
Yes. So what we're looking for in a lot of these things we're doing is temporary relief during the pandemic so that the banks can use their balance sheet to support their household and business customers. It's no more complicated than that. So as they've taken in more deposits and as they've engaged in forbearance on things like credit card balances and things like that, their balance sheets grow. So they've been supporting their customers and borrowers, and this is simply a matter of allowing them to do that. It would be a temporary measure.
So you are in favor of at least a temporary measure to modify Section 171 and 171 of the Collins Amendment to allow them to handle this increased credit demands.
Yes, and we'll be happy to work with you on the details of that.
That would be terrific. I thank you so much. The Federal Reserve has noted that non-bank financial institutions are currently not considered eligible lenders for any Main Street loan facility. And in the FAQ guidance, it states that you may consider expanding the list of eligible lenders in the future. Chairman Powell, what is the reasoning for the Federal Reserve excluding non-bank and non-insured depository institutions from being eligible lenders under the Main Street lending program? You know, is it not possible to create a lender agreement similar to one that we issued by the Department of Treasury for non-bank and non-insured depository institutions like we did for the Paycheck Protection Program?
No, it is possible. It is possible. We've been engaged in a sprint here to get these programs set up. And so that's what we've been doing. It's a little bit, I would liken it a little bit to like Dunkirk, you know, get in the boats and go, bring the people back. That's really what we've been doing. So in the case of this, now that we've done that, we can go back and we can look at various provisions, including the one you're talking about.
Well, my time has expired, but I hope you do take a careful look at that and that we're also able to modify the Collins Amendment. I thank you, Madam Chairwoman, and I yield back.
Thank you. Mr. Perlmutter, you're recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, thank you for the hard work that you and your staff and the Fed have put in very difficult circumstances. And taking a look at your monetary report, just if you look at the first 4 graphs in the report, the last few years you've been here, or Chairman Yellen, they've been sort of consistent, steady growth since the Obama administration into the Trump administration. And now I know the definition of falling off a cliff. Those graphs are very telling in the loss of jobs that we've seen. So my first question to you, sir, is in the HEROES Act, there is a substantial appropriation for state, local, and school districts who've seen their tax revenues fall tremendously. In Colorado, just the state government alone is looking at a $3 billion drop in revenue from last year. So I know you're not particularly interested in talking about fiscal measures, but if in fact we weren't to assist state, local, and school districts over the course of the next year or two, and thousands of jobs are lost, I mean, how is that going to affect the recovery that you hope for?
So I will agree that I wouldn't offer specific advice on fiscal policy. I will say, though, from an economic standpoint, state and local governments employ something like 13 million people. States have to balance their budgets, and when revenues go down and expenses go up, what do? They cut costs. And we've seen state and local governments lay off already 1.5 million people. State and local governments provide essential services, as we all know. So, you know, they're a very large employer, and I would say it's certainly worth considering all of that. It will hold back the economic recovery if they continue to lay people off and if they continue to cut essential services. And in fact, that's kind of what happened post the global financial crisis.
All right, and so I thank you for that. I mean, I guess I'm going to summarize your answer. Laying off a lot of people will not help the recovery. And I saw today, even a substantial company like AT&T announced it's laying off thousands of people as part of a restructuring or something. I didn't read the entire article. But I have in your report on the second page, it says the strains on household and business balance sheets from the economic and financial shocks since March will likely create persistent fragilities. What did you mean, or whoever wrote the report, what did you mean by persistent fragilities?
So this is what we mean by that. Something like 25 million people have been displaced in the workforce overall, either fully or partially. And those people are right now, they're getting enhanced unemployment insurance, perhaps. Many of them may have gotten support checks as part of the CARES Act. But over time, they don't have a secure income flow. And when they to the extent they lose those benefits that they're getting, they're going to come under financial pressure right away. Most low and moderate income households don't have substantial financial assets to fall back on. And it's the same thing with smaller businesses. They don't tend to have substantial quantities of financial cushion to fall back on. And that's what our surveys show, both for households and businesses. So they'll be under strain. And of course, the prospect of facing that kind of strain is already strenuous and causes people to pull in their spending. And those are the kind of things that, become self-reinforcing for the economy.
So you put together 11 different facilities and, from corporate bond purchases and municipal and all those kinds of things. Is there anything that you would like to do from a monetary and the position of the Fed that the Treasury or the administration has prevented you from doing?
The answer is no. We have very specific powers, which are lending powers. In addition to our regular monetary policy powers, we have lending powers that we've used to a completely unprecedented extent here. And I think we've been able to broadly do the things that we felt were most in need of doing. Of course, the powers that are going to matter so much going forward and have already mattered are really the tax and spending powers.
Well, I thank you for your testimony and your work, sir, and I yield back to the chair.
Thank you, Mr. Rose. You are recognized for 5 minutes. Mr. Rose is not present. Then we'll go on to Mr. Stile. You're recognized for 5 minutes.
Hello?
Is this Mr. Stile?
Can you hear me?
Yes.
Okay. I was talking, Chairwoman, if I can begin.
Yes, you may begin.
Okay. Thank you, Chairwoman Waters and Ranking Member McHenry, and thank you, Chairman Powell, for being with us today. As we move through the pandemic recovery process, I am really encouraged by the early economic results. Obviously, we still have much further to go, but again, I'm encouraged. And I credit the administration led by President Trump and the institutions like the Fed and your leadership for helping us to so quickly work to revive the economy. However, I received news yesterday that makes me a little less encouraged and more concerned. I received a call from a bank here in Tennessee's 6th Congressional District yesterday alerting me to the fact that they have been notified at the beginning of this week by the Fed that they would only be receiving a small portion of their weekly order of coinage. According to this banker, his institution will likely run out of coins by Friday of this week or this weekend. And after some preliminary research, I found that many other banks across my district are having the same operational challenge. My fear is that customers who use these banks will react very poorly. And I know that we all don't want to wake up to headlines in the near future that such as banks out of money. Chairman Powell, I wonder, are you aware of this issue and what is being done to mitigate it?
Thank you. Yes, I am aware of it. I'm very much aware of it. And let me say, what's happened is that with the partial closure of the economy, the flow of coins through the economy has it's kind of stopped. The places where you go to give your coins and get credit at the store, get cash, get folding money, those have not been working. Stores have been closed. So the whole system of flow had come to a stop. We're well aware of this. We're working with the Mint and we're working with the reserve banks. And as the economy reopens, we're seeing coins begin to move around again. So if the bank hasn't already done so, they should certainly be in touch with their reserve bank to report this situation. And we've been working on this problem, and very much appreciate your bringing it to our attention. We feel like we're making progress, but it's been something that we've been working on.
Chairwoman Waters, I'd like to submit for the record this release from the Fed, strategic allocation of coin inventories.
Without objection, such is the order.
Chairman Powell, I wonder, and to some degree you've already spoken to this, but is this indicative of a larger issue? And is it temporary, or is this point to a larger structural issue on this particular matter?
No, we believe it's just temporary. It's due to the fact that of the economy being in significant part closed, as I mentioned, and the flow of coins through the economy. Something that the reserve banks and the banks think about it all the time, but now we're beginning to see those shortages. We've been aware of it. We're working with the Mint to increase supply, and we're working with the reserve banks to get that supply where it needs to be. So we think it's a temporary situation.
And if you would give, I guess, the banks that I'm talking with, like the one that I mentioned in my district, what would you suggest they do to deal with this issue? And I'm thinking particularly not only about the banks, but their customers, businesses, and the consumer who is going to be faced, all of these institutions and individuals are going to be faced with the prospect of having to round up or round down. And in a time when pennies are the difference between profitability and loss, it seems like it might be a bigger concern than the announcement from the Fed would indicate that it is.
So I would encourage your banks to get in touch with their reserve bank. I don't know whether you're Atlanta or St. Louis, but whichever, it may be both in your district. I don't know, but in any case, they're responsible for this, and we're working hard on it.
Thank you, Chairman. I would just encourage you maybe to put out some more robust guidance for banks so that they don't feel the banks that I've been speaking with all have the opinion that they don't know what to tell their customers. So I just encourage you to maybe put out some more robust guidance to them.
I want to thank you for bringing that up. I'll certainly do that.
I am a co-sponsor, along with several other members of our committee, of HR 2650, the Payment Choice Act of 2019, a bipartisan supported bill which would require merchants to accept cash. This legislation, I believe, is critical because parts of the country in both rural and urban areas are more dependent on the cash economy. I see that I've run out of time, but I would encourage my colleagues to take a look at and support this bill. Thank you, Chairman Powell. Thank you, Chairwoman Waters. I yield back.
Mr. Himes, you're recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Chairman Powell, for being with us today. And thank you for your extraordinary efforts and the efforts of the Federal Reserve to contribute to the emergency rescue that we've all witnessed. I've got at least two concerns, though, that I want to explore with you. And the first pertains to who was the beneficiary of the billions of dollars, trillions of dollars that have been mobilized in the rescue. Chairman, as you know, a company can do three things with its money, right? It can buy stuff, cost of goods sold, rent, insurance, space, raw materials. It can pay wages, keep people employed. And third, it can service its capital structure. It can pay interest on bonds or to banks. It can issue dividends. Chairman Powell, as you know, in the Paycheck Protection Program, we set up an explicit incentive that money be used for wages. My first question, Chairman Powell, is let's start with the primary market corporate credit facility, where you're actually lending directly through the issuance of securities to corporations. Is there any incentive or requirement that recipients of that aid preference the payment of wages over the service of the payment of interest or the purchase of stuff?
I'll put it this way, there's nothing in the CARES Act. The CARES Act specifically exempts the transactions that take place in the primary market corporate credit facility from those requirements. They do apply to direct loans. Actually, no, different requirements apply to direct loans. You're really talking about the requirements of the Paycheck Protection Act.
Yeah, no, I mentioned the Paycheck Protection Program obviously explicitly created an incentive for the use of that money to pay wages and therefore keep up employment. It doesn't sound like the Fed lending, the primary market corporate credit facility, has those protections. Let me ask you to reflect, and I can't run through all 11 programs, but the commercial paper funding facility, the primary dealer credit facility, the money market mutual fund credit facility, all of these credit facilities, are there any terms in the availability of that liquidity that preferences the payment of wages over the servicing of debt by corporations?
No, there aren't. And, we're implementing the law that you passed. The CARES Act specifically does not apply those things. And we don't think it's up to us to kind of rewrite the law to achieve goals we might have. I negotiate carefully on as part of
the legislative
process.
I mean, having lived through the political fallout of the TARP program, when America saw the banks and the auto companies bailed out and the preservation of an awful lot of the shareholders and the bondholders associated, I'm very sensitive to programs that ultimately use public money to allow corporations to avoid bankruptcy and service their debt and ultimately pay dividends. So I just commend that to my colleagues as something of real concern, because when the story is told here, I think a lot of private, and I'm not just talking about corporations, I'm talking about the car wash guy down the street who got who qualified for a loan. A lot of that money will have been used to keep banks solvent, to preserve loans, and to service bonds. Chair Powell, I want to explore another deep concern I have about these. As much as I support your efforts and the Federal Reserve's efforts to bail us out here, in my 1 decade plus or minus doing this, this is now the second time in which it has been necessary for the government, the Federal Reserve, and fiscal policy to step in a truly massive way to bail out the economy. 10 years ago, it was the banks, it was the auto industry. Now we're seeing the airlines, and the list goes on and on and on. And the worry I have, which relates to my first worry, is that actors in the private market, and I was once in the private sector, are going to decide that they can take on a lot more risk, repurchase shares, dividend capital, because when the going gets tough and catastrophe hits, we'll be there to bail them out. So I want to use my last, 40 seconds or so to ask you to reflect on whether you think that the activities of the last 6 months and of the last 10 years have created significant moral hazard in our market system.
So let me first say that, of course, the intended beneficiaries of all of our programs are workers, and we're able to keep their jobs because companies can finance themselves. So that's really the point of it. You raise a good question, and I would certainly it's a concern, and that's why, generally we don't look for ways to insert ourselves into markets when they're functioning. This is a world historical event, unlike any other. The situation that happened is one where we really felt like we had to come in with all of our tools as aggressively as possible. And I don't regret those decisions. I do realize that's why I always say that we'll put the tools away. And I take it very seriously. Ultimately, in a free market, in an economy like ours, you should get the benefits of your success and the cost of your failures too. And that's the way it should work. So,
thank you, Mr. Chairman. I yield.
Mr. Stahl, you're recognized for 5 minutes. Mr. Stahl, present? If not, Mr. Taylor, you're recognized for 5 minutes. If not, Mr. Lucas, you're recognized for 5 minutes.
I mean, my cursor to the right spot on the screen, Madam Chairman. Thank you.
Thank you.
Chairman Powell, for 5 years, I've worked very diligently in an effort to unlock at least $45 billion in capital to be available to the economy. And without me saying any more, you understand where I'm headed, the inter-affiliate margin rule. I hear rumors that we might be getting closer to such a rule being announced. Any insights you could provide on that?
I'm happy to be able to confirm those rumors. We are indeed getting close, and I can't give you. I've been under strict orders not to give you a which I will obey, not to give you an actual date. Nonetheless, it's very clear that we are. It's been a long road. I will agree with you, and but we'll get there very soon, I'm told.
I've spent enough time on farm bills. I have enough patience. I'll wait you out. The knowledge of making progress is really important. That said, Chairman Powell, there have been a lot of comments made about the nature of the programs that have been put together and the way the Fed has addressed this unprecedented set of challenges that we've had in the first part of this year. That said, in your experience as a Fed chairman, in your academic training, could you ever have imagined a pandemic of this magnitude with this kind of economic impact, not just on the United States, but around the world?
No, I certainly didn't. You know, like everybody else, I was aware that there were things called pandemics and that they could have consequences. But, you know, you essentially had all over the world governments and people sort of deliberately stopping a lot of economic activity. And we'll see declines in economic activity that just are beyond any in living memory because of the disease. It's akin to a natural disaster. So, so I really do think this is a once in a life. I certainly hope it's a once in a lifetime event. And I hope market participants don't grow to think of it as something where we'll react to any old thing.
Absolutely. And you and I have discussed many times before, coming from my part of Oklahoma, the Great Depression in the 1930s, the Dust Bowl, the dramatic effect of Fed policy in 29 and 30, and Congress's policies, the administration at that time's policies that made things so dramatically worse. 3/4 of the population of my home county went away and has never come back. It is fair to say that doing what we in Congress and what the Fed has done, what Treasury has done, unprecedented as it may be, still is dramatically cheaper than a lack of action. Fair assessment, Mr. Chairman. Putting the economic train back on the tracks costs a lot more than keeping it on the tracks.
I feel very strongly that way. I really do. And, we're going to come out of this. And the more we do now, the stronger our economy will be, the better we're able to keep people working, get tax revenue back up, and have a strong economy to pull us forward and service the debt. We're going to come out of this with more debt. So our banks are going to have taken losses. Households will have run down their capital. Everybody will. Nonetheless, the economy will be stronger, and that'll help everyone.
And ultimately, Fed policy will reflect that new reality, as will fiscal policy in the United States Congress have to reflect that new reality. The piper will have to be paid ultimately. But
yes,
having that bill to pay is how we get to the point of being able to pay.
That's right. And that's why I think this is not a time to worry too much about, the longer run fiscal situation. We'll have to return to that, but I would say this isn't the time to prioritize that.
One last thought, representing a substantial part of the rural area of Oklahoma, making sure that Fed programs work as well in the countryside as they do in the money centers in the big urban areas is critically important from my perspective. Making sure those facilities are available to everybody helps assure the robust recovery. We don't want to leave any particular regions or parts of society behind as we come out of this. And I believe you're working aggressively in that area.
We have tried to, and in fact, I would point to the things we've done with the municipal facility, where we made sure that states that have more rural populations and don't have a lot of big cities, nonetheless, have the benefits of that facility. And we will continue to adjust all our facilities to try to serve that goal.
With that, Madam Chair, I yield back the balance of my time.
Thank you. Mr. Heck, you're recognized for 5 minutes.
Thank you, Madam Chair. I'd like to start by thanking you for setting up the phone call the other day with Chair Powell regarding the issue of commercial real estate and the future of that market and its importance. I don't have time to get into that today, and I wish I did, because we still have a problem, and I'm ringing the alarm bell again. Since I was privileged to join this committee nearly 8 years ago, I've asked at every single Humphrey Hawkins hearing, when does America get a raise? The truth of the matter is that for far too long, indeed I would suggest 40 years, we have been content, and some people have supported, frankly, running the economy short of its potential. I remember when I got here that there were people both on and off the FOMC that thought if we ever dipped below 6% unemployment, it would trigger inflation. And then it was no, not 6, but 5.5, 5, 4.5, 4. And what we know is that we ran this economy between 3.5 and 4% unemployment for 2.5 years. And we maintained, in fact, we were short of the price stability target. The fact of the matter is that during your tenure, Mr. Chair, and I tip my hat to you, sir, you've opened people's eyes about the importance of a tight labor market. You did this yesterday in the Senate, you've done it again here today, and you've done it in public utterances. And we cannot thank you enough. Well done, sir. You have pointed out, rightfully, that tight labor markets help with wage growth, but especially with employment levels and wage growth for people at the lower end of the income spectrum. Again, I want to thank you. But the fact remains, Mr. Chair, that the mission of the Fed is no different today than it was over 2 generations when it never allowed the economy to operate at a tight labor status. The law hasn't been changed and the rules and regulations haven't been changed. So we're going to get past this some point, and the sooner the better. But my question for you is, short of you having a lifetime appointment, which by the way I would support, sir, but short of you having that, how can we be assured that what you have so appropriately pursued will continue? And I want to preempt you a little bit, if I may, Mr. Chair, by saying every federal entity in the history of civilization has resisted opening up the underlying authorizing act for that entity. And the Fed's been no different in my conversations with them. To some degree, I get that. I mean, it's as though you're channeling Will Rogers, who said once, people feel about Congress the same way they do when baby gets a hold of the hammer. You're worried about what might happen if we opened up that act. But there is no assurance that what you have rightfully pointed out, what you have rightfully pursued, will continue to be pursued. How do we assure ourselves that what you have figured out and what you have led the Fed to do will continue into the future if we don't change the law, sir? Did I stump you, Mr. Chair?
I forgot to unmute myself. Sorry. So I actually think the law, as written, does accommodate what we've really learned, what a lot of us have learned, and that is that. For many years, when we were growing up, inflation really was a problem. People weren't imagining that. They really had to watch carefully, or inflation would move up, and it would hurt, people on fixed incomes more than anybody else. So, and what we've learned is that, these disinflationary forces we've been seeing around the world for a quarter century, that they're here to stay for a while, and that, we live in an era of continued downward pressure on inflation. That gives us the ability to have very low levels of unemployment. I don't think anybody's going to unlearn that. I also don't think it's going to be, if you change the law to, the situation will change. The economy's ever evolving, and I don't know that changing the law is what we need to do. I do think we get that, and I think economists broadly do get that now, and that's why we're so eager to get back to where we were and below. We weren't seeing inflationary pressures at 3.5%. What we saw was the gains in wages going to people at the lower end of the wage spectrum for the first time in a very long time. I can't tell you how much we want to get back there and how fast we want to get there. So we'll be using our tools that way, and that's really how I look at it.
Thank you again, sir, for your leadership.
Thank you
very much. Mr. Stahl, you're recognized for 5 minutes. Mr. Style available? If not,
We can't hear you, Brian.
Mr. Style, are you recognized for 5 minutes?
He's talking, but we're not hearing.
Yeah,
I
it's, can staff look into whatever technical difficulty there is because he's unmuted, it appears.
So let's see, we have a little technical difficulty here. We're checking with our staff. Mr. Style, we cannot hear you. He cannot hear us. So we're going to move on while they're trying to correct that to Mr. Taylor. Mr. Taylor, ready? You have 5 minutes. If not, we will move on to Mr. Lukemeyer. You're recognized for 5 minutes, and we'll get back to you, both Mr. Style and Mr. Taylor. Thank you.
Thank you, Madam Chair, and thank you, Chairman Powell, for being here today. Thank you for your quick action over the last several months to set up these different facilities to be able to underpin our markets and to minimize the damage to our economy. It's amazing to see what you've done, the impact it's had, and we certainly appreciate all your efforts. Thank you very much. With regards to my questions, in your most recent monetary policy report, you stated how lending standards for both households and businesses have become less accommodative and borrowing conditions are tight for low-rated households and businesses. What I think you're seeing is financial institutions are beginning to look 3 or 4 months down the road and preparing for regulators and their exams to come into their institution after this period of forbearance and begin classifying loans and force banks to reserve against those assets. I can tell you from talking to bankers across the country that if the regulators do not give forbearance to these financial institutions, and they start forcing institutions to classify whole lines of business, classifying whole lines of business, there's going to be a real problem with a credit shortage in rural areas and in low MI communities. Do you believe the regulator should be providing this forbearance, and what do you think it should look like?
So we are encouraging our supervisors to encourage banks to work with their borrowers and not to jump to criticize loans and to take on board, the situation that we're in. And we're communicating with them, a lot in that respect. And I hope that's getting through to the banks and that it's in fact then getting through to the borrowers. We don't want to force anything to automatically happen. I guess it's natural that in a situation like this, where businesses are partially closed or people aren't spending, you'll see concerns about credit. But this is clearly a temporary period, and we're just going to continue to urge banks to work with their customers, household and business customers. And
I appreciate that comment, sir. But and your earlier comments talked about some businesses struggling and the need for forbearance, and I appreciate that. But I can tell you, having gone through this PPP program, that the banks, with their accountants and attorneys close at hand, are very reluctant to do anything unless there is some physical guidance there, some words on paper that they can point to. And so I've got a bill to try and put something in place that they can point to give them the kind of forbearance and protection they need to be able to then give forbearance to the customers. My greatest fear is we wind up with a situation like 08 and 09 where the regulators go in and get rid of entire lines of business, close down entire industries, and hurt local communities and wind up losing banks in the process. We can't do this in this situation. It's true broad-based. If we do this, we're going to never get out of this economic downturn. And I'm very hopeful that you'll work with us to try and come up with a solution to make sure there's something that the banks can point to provide the kind of forbearance they need, the certainty they need to be able to manage their customer base.
So we're trying to give them that, and we're also doing additional training of supervisors. And I just point out too that banks came into this quite well capitalized, and so that helps as well. There's going to be some more guidance, though, interagency guidance on post-pandemic exams and how we conduct those. So we're working away at it, and we really want to hear from banks and from supervisors and anybody who to the extent it looks like this is not getting through, because we really don't. This is effectively a natural disaster, and we want to treat it like that.
Just a quick comment here. I know that the Secretary Mnuchin made a comment the other day that he's seeing an increase in deposits. I know anecdotally, locally here, there's the local banks in the area here. Looks like there's 10-20% increase in deposits. Savings have increased. Have you seen that same thing happening? What do you ascertain from that as to why and what kind of effect down the road it will have on the citizens of our country having that sort of money at hand ready to be spent?
Well, part of it is, the answer is yes. We're seeing a lot of that. And you saw it in the income data where people are holding just very, very high levels of savings right now. And part of that is that they're getting, the PPP loans, and some of those turn up in personal bank accounts. It's also the enhanced unemployment insurance, and it's the checks. And they've been holding back. I think getting to your point, what it is evidence that there's a lot of spending power, and we're starting to see that in the spending data too. Yes, so I think it bodes well for the next few months.
Thank you. I yield back, Madam Chair.
Thank you. Mr. Vargas, you're recognized for 5 minutes. I'm going to go back to Mr. Stile. Has the problem been corrected with Mr. Stile?
I hope so, Chairwoman Waters. Are you able to hear me
Yes,
this
I
time?
can hear you now.
Thank you very much, Chairwoman Waters. And thank you very much for being with us here today, Chairman Powell. I look forward to being able to do these meetings in person as we work through some of the technical glitches here. During and immediately following the financial crisis of 2009, the Federal Reserve's balance sheet grew by north of $2 trillion, reaching about $4.5 trillion. In your comment following up to Congresswoman Ann Wagner's question, you noted that the Federal Reserve has been mostly holding to maturity. Wondering if you could comment what the economic indicators that you were looking at the Federal Reserve between 2009 into 2019 as the Federal Reserve dropped the balance sheet by roughly half of $1 trillion, and whether or not those same economic indicators will be guiding you as you make determinations in the Fed as to whether or not you'll be needing to hold those reserves all the way through their maturity, or if there will be opportunities to reduce the Fed's balance sheet in advance of that maturity.
So we waited until the economy was well down the path of recovery before we even thought about starting to shrink the size of the balance sheet. And the other thing that we did was we froze the balance sheet at the end of 2014. We froze the size of the balance sheet, pardon me, for a period of 3 years, so that the economy was growing, and therefore the ratio of the size of the balance sheet to the economy was declining. And I think we declined from maybe 25% of GDP to maybe 17, 18%. So that's a passive way to allow the bank balance sheet to shrink relative to the economy. I think in this situation, we're thinking that we may do something like that, but it's so far down the road. I think we're at the beginning of the second phase of this process, the one where the economy begins to recover from the shutdown period, and that period will take some time, and then there'll probably be a lengthy period as we get back to full employment. So it'll be a while before we start really thinking about how to shrink the balance sheet. And I would say that at current levels or current planned levels, I think we know now that the balance sheet doesn't present issues in terms of either inflation or financial stability. Those were big concerns as we grew the balance sheet during the last crisis.
Obviously, we don't have the inflationary pressures today. I do hold some concern that we may see inflationary pressures in the future as the Fed's balance sheet has now increased beyond $7 trillion. And obviously, you and your colleagues at the Federal Reserve will continue to watch that. Let me shift gears slightly. We've seen articles recently related to collateralized loan obligations, risk that may pose in the banking sector. I think what's important here to note is banking institutions came into this crisis with a much healthier balance sheet than they did in 2009. There was recently an article that was put forward identifying potential risks in the collateralized loan obligation space and indicating that banks may have broader systemic risk. Could you comment as to whether or not you hold that view or whether or not you believe banks came in with a strong balance sheet and are therefore well capitalized to weather these challenges?
Sure. So the CLOs are quite different from the things that were problems back in the crisis. We have a lot of transparency into what's inside the CLOs. We regularly include them in our annual stress tests. We stress them really hard to see what kind of losses they produce. And they're also, they're not that large. I think it's less than 0.5% of the assets of the banks are in these CLOs. So it's something if they contain leveraged loans, we've been all over that problem for several years and looking at it carefully. So I think the comparison to the global financial crisis is not the right one. Nonetheless, it's an issue we will continue to monitor.
I appreciate that, and I appreciate you monitoring that as well as the increases in the Fed's balance sheet and the risk that may pose to inflation down the road. Appreciate you being here today, and I yield back. Thank you.
Thank you. Mr. Vargas, you're recognized for 5 minutes. If Mr. Vargas is not present, we'll move on to Ms. Acne. You're recognized. Please unmute yourself.
Good day, Chairwoman, and hello, Chairman Powell. Thank you so much for being with us again today, and thank you for all the good work that you do. We're very appreciative. Obviously, we know these are difficult times that we're in. For the second time in a dozen years, we're in a severe recession. I believe that in May, we saw that 20 million less Americans had jobs than they did 3 months prior. So unemployment's at its highest rate since World War II. And the Fed's projections have that remaining at almost 10% through the end of the year. We've also discussed, to make matters worse, that situation appears far worse for lower income workers than it does for others who are making more. Chairman Powell, you've somewhat alluded to it today, and I believe yesterday, I think you said you've been concerned about the overall deficit for the long term, but that the time to address that is when the economy is strong, not when we're in an economic crisis. Is that correct?
I'm sorry, I forgot to unmute myself again. So yes, I do think that ultimately the debt can't grow faster than the economy forever. That's sort of the definition of an unsustainable path. We've been on that for a while now, and we need to address it. We will have no choice. Ultimately, we have to address it. The time to do that is when unemployment is low and the economy is growing.
Thank you. Thank you. I couldn't agree with you more. Obviously, each recession is different, but I want to take a look back at the last one to see what lessons we learned, to see what we can look at to help deal with this one. I had an opportunity back in the 2009 stimulus bill timeframe that I know we devoted about 20% of that total aid to fiscal support for state budgets. And that's when I was working at the state of Iowa and in charge of supervising some of that funding. One thing that I saw was that when that assistance started to end in 2010, because of balanced budget requirements that we have, for instance, at the state of Iowa, we had to cut budgets, meaning teachers, firefighters, public servants, et cetera, lost their jobs. And then I've also seen some research from the International Monetary Fund and others showing that these cuts were a drag on the economy for several years afterwards. And some of those estimates showing that the jobs lost due to these cuts actually offset the job growth in the public sector entirely. Does that impact seem like it might be part of the reason why the recovery from 2008 recession was so slow?
Yes, that is a finding that economic research has come up with, I think, pretty clearly.
I appreciate that. It seems like we're in agreement that supporting state and local budgets is a key step to supporting the recovery process. I know we're absolutely trying to work on getting that piece through the House, and it's something that I've worked on. Do you think that that's something Congress needs to be doing more on to make sure that we recover our economy?
So, as you point out, state and local governments are large employers, and they provide critical services to people, and there's a balanced budget provision effectively in every state, or almost every state. And so when there are budget problems, what happens is you see layoffs and cutbacks in essential services. Both of those create not just human misery, but they also weigh on the economy. So I do think it's an area where it's possible for Congress to look.
Well, thank you. Obviously, we're trying to push that through. I actually have a bill that I wrote previously that directly supports state and local governments for lost revenue to ensure that these job cuts don't happen again. I appreciate all that you're doing to help us shore up our economy at this point, give us the guidance and the oversight that we need. And I'm grateful for your feedback here today. I hope that we can move a state and local government bill forward. Thank you so much, and I yield back.
Thank you. Mr. Huizinga, you're recognized for 5 minutes.
Thank you, Madam Chair. I appreciate it. And I, like the ranking member, just think of our mutual friend, Andy Barr right now, and his daughters. And I know, Chairman, he would love to be here to grill you about a number of issues, as he and I had both previously chaired the Monetary Policy and Trade Subcommittee. But I need to touch base on the Paycheck Protect. Two things. Main Street business that is not eligible for the Paycheck Protection Program, and as you well know, a huge part of our manufacturing economy is in automobiles, especially automobile parts. Those account for about 900,000 jobs, 125,000 of those here in Michigan alone. And what we are seeing and hearing from the large automobile manufacturers is their concern for their suppliers. And those suppliers are telling me, which I have a tremendous number of here in the 2nd District of Michigan, that they're having some liquidity issues. Not that they don't have been properly funded previously, but it's about liquidity right now. Last month, I joined with my Michigan colleagues in asking the administration to create a fund that provides short-term lending assistance to medium-sized companies in the motor vehicle parts sector using necessary capital from the Main Street lending program. Now, you had said, and I had written it down, I think you had said we are there in standing up the Main Street program. I'm not as convinced, I guess, of that, and I'd like to make sure that you can commit and maybe clarify what that means. We need to have this up now. And what I really want to know is, will you commit to working with Treasury Secretary Mnuchin to add a dedicated program for the auto part sector focused on size companies to keep production for key links in the motor vehicle part manufacturing viable? Because if we lose them, that is going to be a huge part of our to be hit. I'm wondering if you'll commit to working on that.
So the facility is open now for lenders to register. So those companies will have banks that they work with that are their regular partners in business, and those banks should be in the process of registering with the Boston Fed to become an approved lender in the Main Street facility. At that point, they can make Main Street loans right away. And, very shortly, they'll be able to put 95% interest in those loans. So we're there. Effectively, if their banks are.
How about a separate facility within that program?
We try to set, we don't do facilities for individual industries. What we do is we set, the requirements that we've set up should be a very good fit for the companies you're talking about. Essentially, we're looking at 2019 financials, and you can borrow at a multiple of your 2019 EBITDA. So, and that could either be 4 or 6, depending on the kind of a loan you want and the kind of company it is. But so these would be a perfectly good fit for this facility. And we don't do facilities that are designed for individual industries. We do facilities of broad applicability, and anybody who meets those requirements can borrow.
So I hear no on no specific program dedicated to the automotive industry, correct?
That's right.
Okay, I think that's a mistake. However, I need to move along to another unintended consequence, I believe, as part of the Paycheck Protection Program, and a company that is not able to take part in that, but is waiting for this Main Street lending program. I have a company here in Michigan, in the district, that probably many of my colleagues have had their product, Lacombe. It's coffee, and a 26-year-old, very fast-growing company that has manufacturing facilities here, a couple of hundred constituents, but they're all based in Philadelphia. For the last 6 years, they have been focused on growth, and they also means they've had to borrow funds, to which has led to accumulation of quite a bit of debt. The rules are currently written so that Lacombe would not qualify to participate in the Main Street lending program. I believe the way that the leverage ratio requirements in the program is currently drafted, it unfairly punishes companies such as Lacombe that would otherwise be viewed as true American success stories when using different metrics. As if the rules are currently written, it's designed to prevent funds from going to the companies that need them most. And I understand that you're not wanting to deal with over-leveraged companies being bailed out, but we're talking about growing companies that have had to accumulate debt. I'm working on with some colleagues a bipartisan letter that would help that. So we'd appreciate it if there would be a different ratio, 1-to-1, independently appraised within the last 12 to 18 months, and the ability to access that. Then, so forward to hearing from you offline on that.
For either of those kinds of companies, if we're missing something, then we want to understand that, and we've been willing to adapt these programs consistently. So we'll look forward to talking about it.
Wonderful, thank you, appreciate it.
Thank you, Mr. McAdams. You're recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chair Powell, for being with us and for your leadership during this difficult economic situation due to the coronavirus. So, Chair Powell, since the last time you were before this committee, the OCC moved ahead with its rewrite of the Community Reinvestment Act, or the CRA. And in light of the renewed focus by Congress to address racism and systemic issues throughout our economy and throughout our nation, I think it's particularly important that we get the CRA correct. And since its historical purpose was to address redlining against Black and minority individuals and communities, and to have financial institutions meet the credit needs of these communities. So I think many of my colleagues share my concerns that the OCC's rule misses the mark and probably does more harm than good. And I'm glad that the Fed did not sign on to the rulemaking. In January, Governor Lael Brainerd gave a speech on how to strengthen the CRA. And in that speech, she said, quote, "By sharing our work publicly, we hope to solicit public input on a broader set of options for reform and find a way forward, a way toward interagency agreement on the best approach." So now that the OCC has finalized its rule, is there any update that you can provide for the committee on how or when the Fed may move forward on any of the public input it received on its CRA framework?
Sure. So first of all, CRA is for us a extremely important law, and we agreed that it's a good time to update it. We would want to update it in a way that has broad support among the community of intended beneficiaries. That's always been our one non-negotiable condition for it. So we're still working on it, and I do think we'll move forward with it. I don't have much for you on the timing of it, but there's been a lot of great work done, and I like where we are on it in terms of the things the ways we've been thinking about it, modernizing it. We will ultimately move forward, and I can't say exactly when, but we're not going to let that work go to waste.
Thank you. We look forward to hearing more about that and following that. Next question. My perception is that Congress and the Fed has done a decent job of keeping the economy on life support. We clearly aren't doing great yet, and the response has been uneven. But you have double-digit unemployment numbers and higher unemployment rates for African Americans, for instance, and some sectors are hit harder than others. I think Congress has the option, we had the option when this pandemic broke out, of acting quickly or acting perfectly, and I think we chose to act quickly, and I think that was the right call. But by my calculation, the Fed has allocated a little over $200 billion of the $454 billion that Congress allocated to the Treasury and Fed in the CARES Act. Some of that funding was set aside for the Main Street facility that you've already discussed and other facilities. My question is, how do you intend to use the remaining funds? I understand that it takes time to set up various facilities, but I also worry that if we don't move fast enough, then business and individuals and communities may suffer as a result.
First, let me agree that I think the fiscal actions that you took were incredibly timely, and I think will be very well judged over time, even though, of course, nothing's perfect. It's an emergency. You do the best you can. I think, the PPP program, the UI program, the checks, I think all of it's going to wear well over time. And it's certainly helping the economy now through what could have been so much worse of a situation. In terms of the rest of the CARES Act money, it's there when and as we need it. We have a lot more ability to use our lending powers should that be necessary, should it be appropriate. We're certainly willing to do that. I think we've kind of gotten to maybe the end of the beginning here, and now we're getting into the phase of the reopening of the economy. But that money is there if it's needed. Of course, the Secretary of the Treasury actually has the legal authority to deploy that money as he sees fit. But it would be one of the things he can do is put it in our programs, and we stand ready to do more if more needs to be done.
Do you see that essentially as being more of the same as necessary, or is there anything else you're looking at? Any other gaps that keep you up at night?
So I think we've covered now we've got nonprofits now in Main Street. That'll take us some time. We've got small, medium, and large companies. We've got state and local governments. So I think we've covered a lot of the waterfront. We're always open to additional ideas. Mainly, it's a lot of execution now and just continuing to improve what we've done, make it do its job better.
Thank you. I yield back.
Thank you, Mr. Vargas. You're recognized for 5 minutes.
Thank you, Madam Chair. And can you hear me?
Yes, I can hear you, Mr. Vargas.
Just want you to know that I never abandoned you. I was here the whole time. My microphone wasn't working. It was sad, to hear the news of Andy's wife and family. Andy's a friend to all of us, as you know. He on our side too. We love him, and that's really tragic. And I know that we'll all keep his wife and his family, especially now, in our prayers. And again, thank you, Mr. McHenry, for letting us know. I don't agree with Mr. Heck Mr. Powell, that I'm in favor of a lifetime appointment for you. I wouldn't do that to you. I wouldn't shorten your life like that. I think you're too much of a good guy. That wouldn't be fair at all. But I do have to commend you. I think that, you're one of those, what I would call those Republicans of old, stable, dignified, intelligent, fair, charitable. And I think everyone's been looking to you for guidance. And I think that you've been just the right person at the right time. And again, I do want to commend you. And I also want to commend you for highlighting the disproportionate impact that this pandemic has had on communities of color, Latinos, African Americans, and especially the poor. My district is composed of all of Imperial County, which is a border county here to Mexico, and part of San Diego County. Over 70% of my district is Latino. The unemployment rate in Imperial County is a striking 28% in April. That's what it was. And that's basically the same rate that we had during the Great Recession there, 25 to 30%. And the Bureau of Labor Statistics currently states that as of April, the unemployment rate in San Diego County also increased about 15%. Taking a closer look specifically in the areas I represent, such as San Ysidro, which is right on the border, National City, the next little city up, Chula Vista, the next city up, and then the city of San Diego, the unemployment here in April was about 20%. The disproportionate impact of this pandemic on our economy is clear in my district. What policies has the Fed pursued specifically on reducing the high rates of unemployment for African Americans and Latinos during this pandemic? And what policies has the Fed put in place to help ensure that Latinos, African Americans are not suffering from this disproportionately high unemployment rates as we emerge from this recession?
I'm tempted to say that all of our policies are focused on that problem. The way this pandemic worked is it hit companies and parts of the economy that were service economy companies, which involved getting people together in tight quarters and either feeding them or giving them drinks or flying them around or entertaining them. And those are service jobs, which happen to be overly represented. The workforce happens to be consist to a large measure of low and moderate income communities and minorities. So an extraordinarily large portion of those laid off are from those parts of the economy. And of course, it has, as the numbers show, fallen heavily on the Latin population as well as African Americans and women. So we, the tools we have are the tools we have. So we're supporting the flow of credit in the economy to companies so that they don't, so that they don't feel financial stress. We're trying to create an environment in which people have the very best chance to go back to their old job or to get a new job. That's really what all of our efforts are about. Nothing more, nothing less.
But Mr. Chairman, I think that you know that and I agree with you, the type of job that you just described also relies a lot on tourism and restaurants and that service economy. And they seem to be the last ones that are going to come out of this recession. People don't feel comfortable going back. So without unemployment insurance and the enhancement, I mean, how are these people going to make it?
So that's exactly I think that we're going to see lots and lots of people go back to work here in the next few months. We believe that. But the people who are in those parts of the service industry, tourism, of course, a big one, they're going to struggle. Many of them will struggle until the pandemic is really in the history books. And so that's going to be a problem. I think those people are going to need support. It may be difficult to find jobs in that industry at all. And I think we're going to need to support them and help them. As Congress did in the global financial crisis. I think as the years wore on, Congress, re-upped employment insurance a number of times just to keep people in their apartment, keep them there, not being evicted, not having to move into a shelter or move into a crowded place. And by the way, that's going to be a place where the disease can spread more quickly too. So I do think it's important that we provide that kind of help.
And I appreciate those words, and I hope you use your influence as you can to make sure that happens. I do have to ask this, though. One of the things that you said was this pandemic was, it's over. Again, thank you very much for being here and continue to be the person you are. We have a lot of faith in you. Thank you.
Thank you, sir.
Thank you. Mr. Taylor, you're recognized for 5 minutes.
Madam Chair, can you hear me?
Yes, I can hear you.
Oh, terrific. Okay. Chair, appreciate you being here. We are all concerned about the economy as it goes to recover and jobs. Something that is of deep concern to me are the properties that have long-term mortgages where the lender has very little flexibility in their ability to forbear. We as a Congress saw the need to forbear, for lenders to forbear. The OCC provided guidance on March 13th, encouraging banks, which are the biggest of lenders in our economy, to forbear. We have given guidance to Fannie and Freddie to forbear. We have worked on legislation and financing, trying to help encourage forbearance. There are pockets of the economy where there is not the ability for the lenders to forbear at a level that is going to help them get to the other side. I'm specifically concerned about 3 subsectors in real estate: hospitality, student housing, and indoor retail, where it is going, because of the pandemic, they have no cash flow or very little cash flow. They cannot service their mortgages. They cannot service, they can't pay for the utilities. They can't pay for insurance. They can't pay their property taxes. I've been working with a lot of members on this committee and in Congress, Republican and Democrat, from all over the country, who share this concern. I perceive that absent action by this body, by Congress, by the federal government, we're going to see a wave of foreclosures beginning in the fall and going through next spring. That impact on jobs, I think, will be very material as people who are working for hotels, working in indoor retail, people who are student housing, where you have a university town that needs to have the housing to have to run the university, where those foreclosures are going to be very serious, particularly when they're foreclosed and the property itself is closed and the forecloser does not have the expertise or the capital to reopen that business. So assuming that you were to see things the way I see it, where there's a coming cataclysm here, do you have the statutory authority, as you and the Treasury, to open up the Main Street Lending Program or any of your other programs to provide lending authority to someone to then in turn help these properties that are in trouble that can't make their mortgage?
So there are limits, as I think you're referring to, in what we can do. We of course, there are lending powers, and they're very explicit in the law. We have to conclude that we're adequate. We have to have evidence that we're adequately secured, and we cannot lend to insolvent borrowers. So there are lines that we can't cross. Within that, we can take a lot of risk, the question is, for companies like that, you really hit the most affected sectors. We would have to be lending on some sort of an asset-based basis.
Sure.
That is something that we're looking at.
I know you're looking at that, and my question again, it's a yes or no question. Can you do this without an act of Congress, or do we, Congress, need to take an act to give you the authority? Do you have the authority today? If you decided, hey, this is important, we got to do it, we can make these loans to the lower leverage, healthier properties to try to get them to the other side. They've got a liquidity crunch, right? If we get them to the other side, they'll be able to reemploy people, and communities will survive. There are whole communities that are going to die or be very badly impaired if they lose their hospitality space or lose shopping centers that are extremely important to that community. So the question: do you have the authority, or does Congress need to act to give you the authority?
My guess is, without seeing the numbers, if you're talking about low leverage situations where it really is just a liquidity problem, we have that authority. We do have that authority. In some of the cases, though, it's fully levered. Companies are fully levered.
Right. So if you look at collateralized mortgage-backed security loan in the hospitality space, the average leverage level is 63%. So that puts it, so normal real estate is normally levered, 15 to 17 times EBITDA, just to kind of put it in Main Street terms. That's well outside the range of what you can, what you have stated by rule that you can do. Again, my question is, do I have to pass a law so that you can then go lend into this space, or do you have the authority right now to say, you know what, there is a problem, we're going to go take action?
Yeah, I think some of the problems in that space will be better served by fiscal policy. I think we can probably reach some of them on it as well. So the answer might be both.
Okay, thank you. Thank you, Madam Chair. Yield back.
Thank you. Ms. Wexton, you are granted 5 minutes.
Thank you, Madam Chairwoman, and thank you, Chairman Powell, for joining us again today and for all that you're doing in these difficult times. One of the most stabilizing things that Congress did in the CARES Act was to expand unemployment benefits by increasing the benefits by an extra $600 per week on top of those benefits that the state provides. In Virginia, our maximum weekly benefit was $378. So the extra money has been a huge relief to the over 822,000 Virginians who have filed for unemployment benefits since March 15th. But these unemployment benefits, these enhanced benefits, are set to expire at the end of July. Do you anticipate the unemployment rate falling significantly by that time?
I would say reasonably. Many forecasters would say, and I would agree, that we should see strong job creation between now and the end of July. Yes, and that may mean that the unemployment rate comes down.
So one of the arguments against continuing this benefit is that it's too generous. Some of my colleagues are suggesting that employers are having a hard time getting employees to come back to work because employment is more lucrative than what they make in their regular jobs. Is that something that you've encountered as far as your regional surveys of business activity or in the data? Have you gotten any information that employers are trying to hire people back and that they're having trouble doing so because the employees say, I'd rather just kick back and collect my unemployment?
So here's what we've been hearing. It's sort of a little bit different from that. Employers, many employees are reluctant to go back quickly, and it may partly be that the $600 is generous compared to what they make. We know that many of them weren't making that much combined with the other unemployment insurance. But it's also, if it's a service economy job and you're very close to someone, it's a barber shop, it's a beauty parlor, it's a nail salon, any of those things, there's also still reluctance on the part of workers to go back to work at all. And if they can delay that, more broadly, I would say, that's, of course, that program ends at the end of July. I would just say it probably is going to be important that it be continued in some form. I wouldn't say what form, but you wouldn't want to go all the way to zero on that, seems to me.
I'm glad to hear that, Mr. Chairman. And that's what you said, talked about people not feeling comfortable going back to work is pretty consistent with what I'm hearing anecdotally, that people are really concerned about the safety if they have a loved one at home who's elderly or has a compromised immune system. And also, a lot of people in my district, and I would imagine it's the same nationwide, are having trouble accessing childcare at this time because many of those centers have closed. So that's a real issue for a lot of people. Now, former Fed chairs Yellen and Bernanke have endorsed a proposal, which is the Worker Relief and Security Act, that would tie federal unemployment benefits to the state of the economy. For example, changes in the unemployment rate. Do you agree that we should tie assistance to the conditions in the economy, or what are your thoughts on these processes that would have set triggers for the legislation and for the benefits to continue?
So I think, you've got almost 2 months, month and a half really, until the end of the UI program. And I think you're seeing a lot of interesting ideas come up. There are a number of proposals that have come out from bipartisan groups. And I think it's, no doubt you're thinking, what should the next bit of support look like? And I think some of those ideas are very interesting ones that would be, I don't want to endorse a particular idea or program that somebody's proposed, but I do think those things are worth careful consideration.
Thank you, Mr. Chairman. And I want to thank you for all of your transparency in the programs that the Fed is administering, and also for your having these listening sessions and for your willingness to make changes to those businesses that might be eligible for the program, in terms of the money amounts and things like that, by opening it up to more people. And I really appreciate your responsiveness to us in the community. And thank you. And Madam Chair, with that, I will yield back.
Thank you. Mr. Stivers, you're recognized for 5 minutes.
Thank you, and thank you, Madam Chair. Thank you, Chairman Powell, for your testimony and your willingness to be so accessible. I want to thank you for everything you're doing during this crisis. I think your actions have prevented this from getting much worse. I take your answers pretty seriously about what we need to do for people that are still impacted by this crisis, especially folks who are still seeing a lot of unemployment and that aren't benefiting from this coming recovery. And we need to try to help them. And you just answered a question a little bit. You don't want to endorse any one proposal, but are there elements that you think are important without endorsing one single proposal?
I think a couple of things. I think with the unemployment insurance, I think it's important to just keep in mind that some of the jobs are not coming back soon. They ultimately are likely to come back, but those jobs that are in tourism and all those areas where travel, accommodation, restaurants, bars, things like that, those people, they are going to have a hard time finding a job. So I think better to keep them in their apartment, better to keep them paying their bills. And this is a natural disaster. This isn't their fault. And I think we should find ways as a country to support those people and help them through this difficult part of their lives. I think many people will go back to work, though. I think the other one I would mention, and we've talked about it, is just state and local governments do provide those critical services, and we know what happens when they can't run deficits, and so they cut heads, and they're already doing that. I think that's another one which is worth looking at. And the last thing I'll say is absolutely small businesses. We don't want to lose any more small businesses than we absolutely have to here. They are the beating heart of the economy, and so I just think those are three areas I would point to. Can I also just take a second and say,
yes, sir.
I was very, very sorry to see the news about Andy Barr's wife this morning. He's been a great guy to work with. He's a happy warrior. He's a wonderful man, and I know we all feel terrible about it, and he's in our prayers.
Thanks for bringing that up, Mr. Chairman. They're great friends, and we're definitely keeping the family in our prayers. And I know Andy said this morning his number one job is being a dad to his two daughters that now have lost their mom. So we're keeping him in our prayers, and I really appreciate you bringing it up. And I do want to follow up on something you just talked about. In one of the first COVID response bills, we did include $150 billion for local governments and state governments, but we tied that money. We said it had to be used only for COVID response. And I hope that we will, in what you just said, at the very least, untie the strings on that money to start, and then see if local governments and state governments need any more money. I'm not going to ask you to comment on that, but I hope we'll do that in the spirit of the second part of your answer. Obviously, we want to focus on folks who are going to continue to be unemployed and small businesses too. So those are three great pillars, and I really appreciate it. So with interest rates at a near record low, another thing we could do for our state and local governments, our municipal governments, is allow advance refunding so they could take advantage of these historically low interest rates in the capital markets. I don't know how the capital markets would respond to that, but it's another thing that I hope we will do. And I thought I'd bring that up since you just mentioned the importance of state and local governments. Again, I won't ask you to comment on that because frankly, it's not in your purview. So the Federal Reserve did note in its May 2020 financial stability report that the life insurance industry has been adversely affected by a number of factors caused by the COVID-19 economic situation, including that near zero interest rate environment I just brought up. Do you think the near zero interest rate environment is a big impact on our insurance folks? And what help do you think that we should give to make sure that, and I don't know that it's any kind of aid, but obviously we want to help people that are nearing retirement and help people that are savers. What can we do to impact that, knowing that the interest rate probably will not go up anytime right away?
So, the life insurance industry is challenged by low interest rates, and they've had a lot of practice here in the last decade or so. They do come into this highly capitalized, and I would just say, a strong recovery is really what that industry needs, and that's what we're going to work on.
Thanks for your time, Mr. Chairman. I yield back, Madam Chair.
Thank you. Mr. Lynch, you're recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chairman, I want to say, I appreciate you. I appreciate you in there swinging. You've been helping us on the unemployment. You've been helping us on trying to get some of this money out to Main Street. I'm very happy to see your revisions recently on the Main Street lending program. And I want to thank Chairwoman Waters for her relentless advocacy to get that minimum loan size down. It started out at, what was it, $1 billion? And then now it's 250,000. So, no, it was $1 million. It was $1 million first. Now it's down to 250,000. So I think that's much more in the reasonable range for some of our small businesses. I do appreciate that, the payback period has been expanded out to 5 years, and that, for participating banks, you had a 15% skin in the game factor for some of these participating banks that I thought,
probably made the program unattractive to a lot of our local banks, but you've got that down to 5%. So we'll have to wait and see if that's sufficient. But I wanted to thank you for that. The question I had is we had a financial fintech task force hearing the other day where the subject of Chairwoman Waters' Fed accounts. So this is the idea about establishing Fed accounts, basically having the Fed do for the unbanked what they do right now for banks, to give them access, to give them accounts, and to tie them into the economy. You know, I think if Facebook can reach out and provide access to 2 billion daily users a day, I think maybe the Fed could accomplish, 5% of that, even though, it would be requiring the Fed to do some things it hasn't normally done. And I just wanted to know what your thoughts are on the Fed account idea, and if there's any other way that we might address the gap that still exists between some of our folks who are unbanked or underbanked in their areas. Is there something the Fed can do to close that gap? Thank you.
Thank you. So, as you pointed out, we can only offer bank accounts at our reserve banks to depository institutions, not people. I think that would be a very dramatic change in the landscape of banking. And I would worry what would happen to the rest of our private banking system, because an awful lot of people would opt to keep their personal money at the Fed, and then who would do the lending? It could kind of hurt our intermediation process. In terms of the underbanked, though, this is a big part of what we do is work in local communities under CRA to encourage financial inclusion. We also, we enforce the fair credit laws to some extent. We don't have all of that authority, but we have a part of it. So those are things that we do now to to address the needs of the unbanked and the underbanked. And also, we work closely with CDFIs and minority depository institutions as well. They play a big role in doing that. And we have a great deal of outreach and interaction with those institutions, which are active in the communities that really need the help.
Well, I do think that with the change in technology, going away more, you're drifting away from brick and mortar and moving to mobile banking, I think it presents some opportunities that we have not had in the past. So I would just ask you to, treat it with the level of attention that we would if the banks were in trouble, right? I appreciate it. We are asking you to do something that you weren't designed to do, but I think the circumstances and the technology now give us an opportunity to do something. It may not be, changing the Fed's traditional role, but certainly I think we can try to make life easier for these people who are unbanked. And I yield back. Thank you.
Thank you. Mr. Tipton, you're recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, good to be with you this morning. And did appreciate your comments on Andy Barr. On our side of the aisle, he's always preceded me in questioning, and our thoughts and prayers certainly go out to he and his 2 daughters today. And do appreciate you again taking time to be here. Chair Powell, we've heard a lot about the impacts that we're having on the economy, and appreciate the efforts certainly that you have made to be able to address some of the concerns. Really actually was appreciative to be able to see that the Main Street lending program was up and running this week, and we are having some concerns that are being expressed. And under the terms and conditions, they may actually deter some potential borrowers, entire segments of the market, from participating in the program. And the hotel industry, we've talked about tourism this morning, for example, has been one of the hardest hit sectors during the pandemic. But they may not have great access to the MSLP. Again, I know you've heard a lot of concerns out of Congress from the tourism industry standpoint. I do believe it's worth repeating. Certainly a great impact in a district like mine in Colorado. Could you outline whether the Fed has considered that some of the loan terms will limit borrower participation, and whether this could be addressed through updated guidance as you monitor participation in the program?
So some of those companies should be able to, I mean, our facility is open to any kind of company as long as it's an eligible company. And that would include the ones you mentioned, and some of them should qualify, I would think, under our existing standards. Those that don't, we want to understand that, and if there are ways we can adapt, then we'll absolutely look at that. One thing we are looking at, as I mentioned, is some kind of an asset-based lending thing. So I think we're hearing this a lot about those sectors, and it's something we are looking at.
Do appreciate your comments on that. One thing we've seen out of the administration, out of Treasury, has been flexibility. As you noted throughout this conversation, we're in uncharted waters, something that none of us had fully anticipated or ever experienced before, and hope not to again. Trying to be able to make sure that we are keeping jobs created and viability of businesses to be able to continue is critically important. Did want to point out, I've also heard from some industry participants that the financial reporting covenant required under the MSLP may prevent participation. In particular, one thing that's been pointed out has been some of the credit facilities in terms of the requirements are costly for smaller applicants who don't currently have the infrastructure in place to be able to create complex quarterly filings. Could you explain why the Fed chose to be able to put these enhanced reporting requirements in place, and do you anticipate potential adjustments as you monitor the borrower participation rate in the program?
You know, we cut back the financial reporting requirements in the last few weeks before we are going live here, just for that purpose. And we thought we had cut them back to sort of close to the bare minimum of what we would need to be able to monitor the performance of the loan at all. If we misjudge that, then we want to know. And we'll be getting that feedback. That's feedback that we want to get. We're trying to make that process as user-friendly and easy and automated as possible. I had thought we certainly tried to address that specific problem. If we didn't quite get that done, then that's very useful feedback.
Okay, thanks. And one thing that as we entered this crisis, we stepped back 3 months. I think in conversations that we'd had, you'd noted that our banks were well capitalized. Is it still your sense that our banks are well capitalized? I think we've seen them on the front lines trying to be able to deliver PPP, to be able to get that assistance out. And did appreciate the comment that you'd made in terms of the examinations, by the way, to be understanding that our banks have been put in a challenging situation. But in terms of the capitalization, do you still see the banks well capitalized?
Yes, I do. Banks have been generally a source of strength here. They've taken on deposits. They've offered a lot of forbearance to their individual and business customers, and they're making loans. We're in a whole lot better shape to face this situation than we were to face the last situation in 2008 and 2009, where the banks were really part of they were at the source of the problem. Here, that's not at all the case.
Thank you, Chairman, for being here. And yield back, Madam Chair.
Thank you. Mr. Phillips, you're recognized for 5 minutes.
Thank you, Madam Chair, and Chairman Powell for being with us. I too want to add my condolences and heartfelt sympathy to Andy Barr and his children. I grieve with them, as we all do. Chairman Powell, I know you're not here to be a prognosticator, but could you please share with the American public, as simply as possible, what households should expect from an economic perspective in the months ahead?
The way I look at it is this: you can think of this as taking place in 3 stages. And the first stage was the shutdown. And we know what that looks like. It's a lot of people who can work from home, working from home, many, many people being laid off. And we've been through that. That's sort of the second quarter. And I think we're now probably in the early stages of the second phase, which is, call it the bounce back, the beginning of the recovery. And I do think, assuming that the virus remains, significantly under control, you make that assumption, what we should see is, companies opening up again, workers going back to work, and you should see positive data coming out, and the economy starting to reopen, and that's what you should see during this phase. I think most forecasters, just about all forecasters, then see there's a third phase, that there will be some parts of the economy that struggle to recover, and those are the ones where people get close together to be fed or entertained in all those areas we've been talking about. And that area is going to take a while to recover. It's going to take the public a while to gain confidence that it's safe to engage in those activities. And there are a lot of workers who work there. And so that group is going to struggle. They're going to need support. They're going to need help. And I think that's the way I see it. But I think the incoming data suggest that we're at the beginning of that second phase of recovery, reopening, and expansion. And, that's the road. We need to get on that road and stay on that road. And, before you know it, things will feel a whole lot better.
And Mr. Chairman, I'm sure it's fair to say that consumer psychology will change. Consumer psychology is going to change in perpetuity. I'm sure you've given that some thought. What should we be thinking about as we move forward as lawmakers relative to a changed economy because of the pandemic and the economic disruption?
In the meantime, I think the focus should be getting through this critical phase. As policymakers, what help does the economy need to transit this critical phase and really get going again? That's what we're thinking about. I think longer term, these are interesting questions. It does seem very likely that people have learned that for certain jobs, you can do them anywhere. I guess we kind of knew that, but now we really know it. And so what's going to happen with people in a whole lot of industries who can really do their jobs from home if they want to, or from a particular place of work, or from another state? The technology has really moved to a place where you can do amazing things that we didn't have to do before. This conference call is not something we had regularly done, and it's becoming very routine. The technology is getting better. We're all getting used to it. There's still glitches. There are plenty of glitches here at the Fed on these things. So I think we're going to learn that this is, in a lot of ways, it's accelerating pre-existing trends too. There are existing trends that just got sped up a lot in the economy, and the more online shopping and things like that. So that's something we're thinking about. The main thing we're thinking about: what do we got to do to make this recovery get off to a really good start, get a lot of people back to work, support the economy, and we're not thinking about putting down our tools for a long time.
And Mr. Chairman, with that in mind, you advised us to go big, and we have. Our national debt is approaching $27 trillion. Our debt service on an annualized basis over $400 billion a year. Do you have concerns about our ability to manage that, to pay that bill, if you will, moving forward? And any counsel and guidance you might share with we lawmakers as we contemplate some degree of fiscal responsibility moving forward?
First of all, I think Congress did go big, and it has gone big, and I think it's been appropriate, and I think it'll be well judged over time. In terms of the national debt, I think the time will come when it's time to return to the concerns of fiscal sustainability. Sustainable fiscal plan is one that you stay on for many years. It's not something where you flip a switch and then really go into difficult times to get. It's really ideally what you do is you get in a situation where the economy is growing faster than the debt, and you stay on that path for a long time. That's how successful countries have done it. We'll need to get to that, and we will. I think we don't need to get to it until we get well and truly through this extraordinarily challenging time.
Thank you, Mr. Chairman. Are you back?
Thank you. Mr. Williams, you're recognized for 5 minutes.
Thank you, Madam Chairman. And I also want to say my prayers go out to Andy Barr and his family with the passing of his beautiful wife, Carol. Mr. Chairman, thank you for joining us in this virtual setting during these strange times that we're in. Previously, when you have come before our committee, we were talking about how we can continue to build on the historic economic growth that we all were experiencing. Now that we are talking under very difficult circumstances, I'd like to focus on getting back to where we were pre-coronavirus. And as we've talked about before, small businesses are the main economic engine. And as you know, I am a small business owner, and we're the job creators in our country. And I'm one of those that believes we could have growth in the fourth quarter. I feel pretty good about that. So what do you think needs to be done to support these Main Street businesses as they attempt to remain viable as the lockdown across our country ends?
So as the lockdown ends and the economy reopens, the first thing is we need to do it in a sustainable way. And nobody wants to do this, but it's really good if we do. And that is, I think, to the extent we can continue to observe those, keep a distance, wash your hands, wear a mask, that kind of thing. That's really going to help. That goes with a fast reopening of the economy. That goes with a successful reopening. So those things are really important. I also think we at the Fed need to keep our foot on the gas until we're really sure that we're through this, and that's certainly our intention. And I think you may find that there's more for you to do as well.
Well, and as traditional snapshot of the banking industry during this unique time will likely not paint a rosy picture based upon the recent shutdowns and phased-in recoveries. However, bank capital levels and reserves remain historically strong, as we've talked about, and there are many borrowers that could return to profitability once the economy rebounds. So, Mr. Chairman, what steps are being taken to ensure that the regulators are taking a reasoned approach to oversight, and how is that being communicated to the various Federal Reserve district banks and the examiners in the field?
We have, on a number of occasions, we've issued public statements, public communications to our supervisory group, and the other banking agencies have done that as well. And essentially, it boils down to guidance that we want you to work with we want the banks to work with their borrowers. We don't want to be, on a hair trigger to classify loans or call them trouble loans or anything like that. We want to look at this as an unusual situation and be flexible and thoughtful about the way we do our jobs. Of course, we haven't been really supervising. We're only starting to supervise again. And at the Fed, we're going to do it remotely. We're not going to be visiting yet, but that time will come, I think, fairly soon. But we're doing training for our supervisors and things like that. So we really want to be. We've also, by the way, we've encouraged banks to use their buffers. They've built up these buffers during good times. And that's a great thing now because they can use those capital buffers to make loans and to work with borrowers.
Yeah. Thank you for that, because it is different than 2008, as we've all talked about. The Atlantic magazine published an article titled "The Looming Bank Collapse. The U.S. Financial System Could Be on the Cusp of Calamity, and this time we may not be able to save it." The point of the article was to compare the threat that collateral loan obligations, or CLOs, pose to the financial systems in a similar way that mortgage-backed securities did during the 2008 crisis. Do you think that the threat of CLOs is properly accounted for? And can you discuss how the Fed has been monitoring this risk?
So I don't think that that's an appropriate comparison. I really don't. This is not the same as the mortgage-backed securities. In that situation, back 10, 12 years ago, there was almost total lack of transparency into what the banks held and how sensitive was it to risks and things like that. That's not the case with the CLOs. With the CLOs, we have really good information. We include them to the extent they're on bank balance sheets. We include them in our stress tests. We stress them under very stressful situations like the current situation. And we know what the losses would be coming out of that. So it's a very, very different situation. That's not to say there won't be losses. There will be losses. This is a severe downturn. But it is one that we have been monitoring carefully and that the banks are well capitalized to deal with, we believe.
Well, thank you. And I want to thank you for being here today. I have a lot of respect for what you're doing. As a business owner, I feel that we are in the comeback mode. As I said earlier, I look forward to having growth in the fourth quarter and a better year next year. So thank you for your hard work, and appreciate your efforts in working with us. I yield my time back.
Ms. Maloney, you are recognized for 5 minutes.
Chair. Thank you, Madam Chair. Can you hear me?
Yes, I can hear you.
Thank you. First, I want to join my colleagues in offering my condolences to Andy Barr and his family, and our hearts are with him. But now I'd like to welcome back to the committee Chairman Powell, and I just want to start by saying that I think the U.S. economy is going to need all the help it can get for the foreseeable future, and I hope you don't take your foot off the gas and continue to be aggressive. In your press conference last week, you announced that the Fed does not expect to raise interest rates until at least 2022, a position that almost all FOMC members supported, and that's a position that I strongly support as well. As you noted, the Fed is being cautious, largely because of the enormous uncertainty about the coronavirus and about the damage to the economy going forward. So I want to ask you, would you continue to hold interest rates at zero until 2022, even if economic conditions unexpectedly improve? In other words, what would cause you to change your position that interest rates should stay at zero until 2022?
Thank you. So what you're referring to there, the end of 2022, that's actually not a committee forecast. It happens to be the median of forecasts of individual committee members. We don't initiate a collective group. So what that really was evidence that that's what our participants do feel. That's their prediction of appropriate monetary policy. It isn't actually a promise to do that. What we've said we would do is we would keep rates where they are until we're confident that the economy has weathered the current situation and is well on the road to recovery. So what would it take? I think we're not thinking about raising rates. We're thinking that this economy is going to need support from monetary policy for an extended period of time, and not just through interest rates, also through our asset purchases and also through the lend. This is the largest economic shock to hit our economy in living memory, and it's also without any kind of precedent. It's the deepest. It looks like it'll be the deepest recession. It may not turn out to be a very long one, but the road back, we believe, and many other forecasters do too, will take some time, and we'll be there to support this economy until we fully recover. As I mentioned, we want to get back to where we were in February, as Mr. Williams was saying. We want to get back to 3.5% unemployment, and wages going up the most for people at the low end of the wage spectrum, where we were, where low and moderate income community people were telling us this is the best we've had it in a really long time. We want to get back to that as soon as we possibly can, and we'll be using our tools to do that.
Also, we have a good sense of what economic indicators the Fed looks at in normal times. You look at the employment numbers, the inflation data, consumer confidence, and all the usual economic metrics. But I don't believe anyone has a good sense of what metrics you'll be looking at now in the middle of a recession caused by a public health crisis, where the economy won't bounce back until the virus is under control. So my question is, what are the key metrics that you're looking at now? Are you looking at rates of infection, hospitalization rates, mortality? What are the public health metrics you're paying the most attention to?
So we are, of course, we're looking at all kinds of economic data, which I'll mention, but we are also now looking, of course, at all the data we can get and hearing from experts about the pandemic, and where cases going down, where they're going up, and all that kind of thing. And so that's a new area for us, and of course for everybody really, other than unless you're an epidemiologist before this. So that's a big thing, and it's almost as though if you could give me if you knew for sure what the path of the pandemic was, then you'd have a lot more confidence in what your economic forecast was. But of course, we don't have that. We're also looking, though, I think for a month or so now, we've been looking at the data that suggests an economic reopening. So you can track, are people moving around a lot? There's a lot of this high frequency data that you get from the technology companies, and it gets published. Are people moving around a lot? Are they starting businesses? So lots of early indicators. And so we've been seeing a great deal of that. You're now clearly seeing spending is ticking up, employment is ticking up. So these are the early real indicators that we've been hoping to see, and we're beginning to see them now.
Thank you, and I yield back. Thank you for coming.
Thank you. Mr. Hill, you're recognized for 5 minutes.
Thank you, Madam Chair. Thanks for conducting this hearing. Of course, our thanks to Lisa, Clement, and Katrina for keeping us on track on the technology. We appreciate our staff. And Martha and I were just so brokenhearted last night at about 8:30 when we learned about the loss of Carol Barr. I can't imagine the pain that Andy feels. So all of us on the committee share that bond of affection for Andy, and we wish him comfort during this tough time. Mr. Chairman, glad to have you back before the committee. And you've done an excellent job today talking about the facilities, the challenges with the facilities, talking about your concerns about how to maintain some fiscal support in the unemployment area, particularly, and your concern about small businesses. So thanks for being so thorough in your answers. As the ranking member on the Monetary Policy Subcommittee, I wanted to turn and talk about the balance sheet of the Fed and monetary policy, and just put some parameters on it as we are in COVID-19 now. And again, thank you publicly for the outstanding job that the Board of Governors did in early March to bring liquidity back to the system and preserve people's access to capital by keeping our capital markets functioning. But I do want to talk about how we measure monetary policy going forward now as we, as you say, enter that midpoint of the return to economic recovery. The balance sheet was about $4 trillion before the pandemic hit, and there was a lot of concern over it at that level in terms of a percentage of GDP and the like. And very quickly, dwarfing anything in the QE days, you have added $3 trillion to the balance sheet, and we're close to $7 trillion. Do you see that range of pre-COVID of 16 to 17% of GDP still a post-pandemic target based on reserves that you see the balance sheet returning to?
I hadn't thought of an actual target, though, but I would say this. In the long run, the size of our balance sheet will be dictated by the public's demand for our liabilities, the two biggest of which are currency and reserves. And so we felt that we were getting really close to that demand at the level you suggest. So, that would tend to be roughly constant over time, I guess, as a percentage of GDP. So it's a place to get back to.
And at the peak in 2014, you owned about 21% of all new issue treasuries and about 40% of new issue agency MBS. And in this most recent phase this spring, as you expanded the balance sheet, I think you're about 19% of the new issue treasury market and about 30% of the MBS market. Some commentators have said, well, housing isn't as big an issue this time as it was certainly in 2008 from a dislocation point of view. But you had liquidity and spread issues in the MBS market. You want to take a minute and talk about why you did engage in the GSE agency purchase?
Sure. So those markets are critical for financing the housing industry, and also they're closely connected to the Treasury market, as you know. And so it benefits all the financial markets and the general public when the Treasury market is working. So in terms of the MBS, there wasn't the capacity and to hold those securities. And what was happening is the very low rates that we were putting in place, they weren't getting through to borrowers. Rates weren't going down. And that's because there wasn't the demand to hold the MBS securities. So we had to get in there and get the market functioning again. And I'm happy to say that it is now functioning essentially normally, not perfectly, but that was really what was our thinking.
Well, I think obviously you had people trying to get out of long-dated maturities in the Treasury market, and you had prepayment speeds pick up. So I understand why you did it. But you do support moving in the long run to an all-Treasury portfolio from a philosophical point of view. Isn't that correct?
Yes. In fact, absolutely. In fact, I had no intention of ever buying a mortgage-backed security when I became the chair.
Would you say that the repo market and the short-term liquidity markets are now functioning after your extraordinary efforts in March, and you're no longer needed in the daily repo market to the same extent?
Yes, I would say that. I also hasten to add that we're still on alert. We feel like we don't take the gains for granted at all.
Right.
Right.
Well, we're grateful for your leadership, Madam Chair. Thank you for the opportunity. And Mr. Chairman, thanks for being before the committee. I yield back.
Thank you. Mr. Sherman, you're recognized for 5 minutes.
Unmute.
Mr. Sherman. Mr. Green,
Sherman,
you recognized for 5 minutes.
Sherman needs to unmute.
He's muted.
Mr. Sherman, unmute.
Can I be heard?
Yes.
Mr. Sherman, are you there?
I'm here. Can I be heard?
No, let's go. We only got a few more minutes left for the other members to be able to ask questions.
Okay. I hope I can be heard.
You can be heard, Mr.
Good.
Sherman.
Mr. Powell, thank you for joining us. Credit rating agencies. As you know, the chairwoman and Congressman Andy Barr led a letter with 16, has written you about this. Congressman Andy Barr has written you a letter about this. There are 9 credit rating agencies accepted for various purposes by the SEC, which has the expertise in the area. Yet the Fed seems to put a premium on only 3 credit rating agencies. Is it your intention to look at instruments rated by all of the SEC accepted credit rating agencies?
We've actually expanded the group of credit rating agencies to 6 from 3, and we're continuing to look at others.
But there's still a situation where you'll accept one of those second 3 only if the same instrument is rated by one of the big 3, or are you accepting all 6 on the same level?
The former, not the latter.
So you haven't given real equality to the 6 that you have decided list. The second issue is when we passed CARES, if a company got a loan from the federal government, it came with strings like no stock buybacks. If you're just going to go out in the market and buy debt instruments, those strings wouldn't apply, of course. The company may have issued that bond a long time ago and has not consented to any restrictions on its stock buyback. Are you planning to have a transaction which in substance is a government loan, that is to say, but is accomplished in form by having the company issue a bond as to which you are basically the sole purchaser? You or the treasurer the sole purchaser.
So the CARES Act is very specific on this, and I wasn't part of this, but my understanding is it was all carefully negotiated. Those requirements do not apply to capital markets transactions or syndicated loans. They do apply to direct loans. The Main Street facility is a direct loan program. The corporate credit facilities are either syndicated loans or capital markets transactions. So, a
capital market transaction is usually one when there are many buyers of the debt instrument issuance. Are you going to have any that are in substance a government loan, but you choose to package them and say that they're capital markets transactions?
I wouldn't. We're not. When we purchase a bond, which is a registered security, and it comes in a normal form, that's a capital markets transaction.
Even if you're the sole purchaser and it has all of the economic indicia of being a government loan, the fact that you can call it a bond issuance liberates you and the company from congressional intention. Is that what you're saying?
It actually affects congressional intention.
It was never our intention to have you take what is in substance a loan and package it as a capital markets transaction. We know a bond issuance is one where there are many purchasers of the same instrument, and a loan is one where the federal government makes a loan and is the sole lender in the transaction, or substantially the sole lender. And it sounds like you've found a loophole in what we've written, and you plan to exploit it. It was certainly never the intention. What sense would it make for Congress to say, well, if you do a government loan this way, there are strings that come with it, but you're free to do it. But here's this loophole where you can avoid all those strings. Clearly, a capital markets transaction is one where the Fed has the additional assurance that comes from other market participants buying that same issuance on the same day on the same terms. And you're depriving us of that if you are the sole purchaser of the issuance, and at the same time you deprive us of the restrictions on stock buybacks. You create a circumstance where money goes directly from the Treasury into the pockets of shareholders who are taking their money out of the company, and that is certainly not what Congress intended. But if there's a loophole, it's up to Congress to plug that loophole. I believe my time has expired.
Thank you. Mr. Emmer, you have 5 minutes. Mr. Emmer? If Mr. Emmer is not present or ready, we'll go to Mr. Laudermilk. You have 5 minutes.
Thank you, Madam Chair. Thank you, Mr. Chairman, for being here. And also, I'd like to thank you for all the work that you've been doing. A lot of times we don't look at how bad things could be. And I think they could be a lot worse right now if we hadn't had the intervention that we've had through the administration.
That came on me quickly. I thought I had another 10 minutes to prepare.
Yeah, I'm sorry. Velasquez didn't show up, and
sorry.
did not send out an updated list.
Well, you can't just rely on a list. You look at the thumbnails. It's either there. Oh, I guess they were suppressing the picture.
Okay. I apologize. I guess I'm getting some feedback. I don't know if anyone else is, but I want to thank you for the actions that you've done. I know we've taken some bold actions, and especially the way that you have made changes on the fly with the way that you oversee and regulate the banks. I know that my local banks, community banks, regional banks were all very skeptical going into this, but I can tell you that they're not happy with the way things are, but they're pleased in the way that things have been going because they realize that they could be a lot worse. Just a couple of quick questions because I know we're running low on time, but you've done a lot for the segment of mortgage-backed securities that are with Fannie Mae and Freddie Mac and Ginnie Mae. Those were included in TALF, but in 2008, mortgages that weren't backed, the non-agency mortgages were included in TALF. And my question, I've written you a letter about this. Are you considering including those non-agency backed mortgages and consumer installment loans in TALF?
So the answer is on MBS, that is something we have under consideration. And you're right. As a general matter, we've been willing to and eager, in fact, to expand things where it's appropriate. Consumer installment loans is a little different. We don't have the history. They don't have a history in the asset-backed securities market, so we struggle a little bit with that one, but we're looking at it as well.
Okay, I appreciate that. One last question. Intercontinental Exchange and other clearinghouses for future trades have had a huge spike in the amount of funds they hold overnight because of the market volatility. And commercial banks can only accept limited amounts of those deposits because of the capital requirements. They'd like to be able to temporarily deposit those funds with the Fed. Is that something that you're considering?
So the only entities like Intercontinental Exchange that can deposit funds at the Fed are those that have been designated as systemically important financial market utilities under the law. And so we don't have the legal authority to do that right now. So it would be a question really not for one company, but for all the companies that are in that category, should they get the legal authority to do that. But as of right now, we do not have the authority to give bank accounts unless they're a designated financial market utility.
Okay. Maybe that's something that we can work on going forward, but I thank you, and I know we're short on time, so I'll yield back.
Madam Speaker, I think mine works now, just for notice.
Thank you. Mr. Lawson, you're recognized for 5 minutes. Mr. Lawson?
Thank you, Madam Chair. And welcome, Mr. Powell, to the committee. Really appreciate the opportunity to talk to you today. Madam Chair said about maybe 2 hours ago there was about 120 billion PPP funds that were still allocated, that was still available to be allocated, and the application number has slowed dramatically. Do you believe that that's an impaired businesses to take an additional debt obligation is limiting the effectiveness of the program, and that in order to create business certainty and confidence in reopening and hiring, a grant program would be better? What do you propose for businesses that cannot take additional debt?
So we don't have the SBA administers the Paycheck Protection Program, PPP. We have a little bit of a role in that once a bank makes one of those loans, we'll take that loan off their balance sheet so they can have the room to make another loan. So I follow it, but it's not one that we administer. I would say, the benefit of that program is that a loan turns into a grant as long as you obey the rules. And I know that the rules have been adjusted by the last, both by the last law that you passed and also in regulatory flexibility. So I would say for many small businesses, that's what they need, and that they're not well served by taking on a loan to make payroll and things like that. So that's the tool we have as a lend. That's all we can really do. We can't do grants. We can only do loans. And that's why we're doing that for larger companies than the ones that are eligible for the PPP.
Okay, and I think when Madam Chair closes out, she might have something to say. My other question is that the April job report was the worst in American history, and the May job report shows that less than half of Black adults have jobs. Chairman Powell, what steps can the feds take to ensure that emergency relief and targeting at the underbanked and the minority-owned businesses in the state of the economy?
Well, all too large portion of those who lost their job in the pandemic were from low and moderate income communities, and many of them minorities. And the same is true of businesses. Minority-owned businesses are under tremendous pressure. We have tools that apply broadly across the economy. That's what we can do, I think. And we can also work with minority depository institutions and CDFIs as well. We do that to try to support the work of those institutions in their communities. And that's what we can do. I know there are also there are things that Congress can do as well and has done.
Okay, thank you, and I yield back, Madam Chair.
Mr. Emmer, you're recognized for 5 minutes.
Thank you, Madam Chair, and thank you for your patience with my ability to use this machine. It goes without saying, but I'm going to say it anyway. Like everyone else on this committee, our hearts go out and our prayers to Andy Barr and his family. a very tough day. Chair Powell, I appreciate you being with us here today, albeit virtually. And even more so after my recent experience trying to get my mute button fixed, I think the House should be back here in Washington doing our jobs. The opportunity to connect with you digitally has brought to mind several topics related to fintech that I've been working on, including as ranking member on the fintech task force of this committee. You know, technological innovations. As late as last year, you told my colleague, Representative French Hill from Arkansas, that you were following central bank digital currencies closely, but that the Fed was not currently developing a central bank digital currency. You said, quote, characteristics that make the development of central bank digital currency more immediately compelling for some countries differ from those in the U.S., close quote. It is true other countries utilize digital cash at a higher rate than the U.S. However, our technological edge has kept us the predominant world leader we are today for at least several decades. And I think the recent pandemic has actually shown that this is an important step that we need to make regardless. What substantive recent actions has the Fed taken to understand and experiment with this technology? And I guess, can you disclose any current considerations or questions you or the Fed have on the concept of a central bank digital currency?
I'd be glad to. So we think I think central banks everywhere, all around the world, are looking at this, and we owe it to the public that we serve to be up to speed and to, if this is something that is going to be good for the United States economy and for the world's reserve currency, which is the dollar, then we need to be there and we need to understand it first and best. So we're working hard on it. There's a group of major central banks that have gotten together to share understanding of the technology and, the cyber implications, cybersecurity implications, the economic implications, the financial inclusion implications. It is a big, complex problem, and it's one that we take very seriously. And again, I think it's our obligation to understand it well and not wake up one day and realize that the dollar is no longer the world reserve currency because we just missed a technological change. So we're not going to let that happen. At the same time, there's some very serious questions that have to be answered before we would want to implement central bank digital currency.
That's great. It's good to hear. It's good to hear that you're leaning in. In the recent report issued by the Digital Dollar Project and reflected in some of the congressional proposals that are out there, there seems to be a recognized need, agreement, that the private sector should be involved in the creation of a CBDC. This is either in its development or dispersal. And I guess through the Fed's work and analysis on the topic that you're currently in, what role do you think the private sector would play?
I really do think this is something that the central banks have to design principally. And we don't, the private sector is not involved in creating the money supply. That's something that the central bank does. And I know there are ideas that this should really be the work of a private board. I don't really think the public would welcome the idea that private employees who are not accountable solely to the public good would be responsible for something this important. I mean, once we assess it and decide what to do, it'll be all about the private sector. It has to work through the banking system and through businesses and the economy for individuals and all that. But I think in the first instance, it's got to be the work of central banks.
Which leads me to probably my last question. If the Fed were to adopt a digital currency, should the Fed have the technical capability to deny access to law-abiding citizens for any purpose? And should it oversee or track transactions between private individuals?
Yeah, those are big questions. You've got to, in one case, if you create a central bank digital currency, you can know every payment by everybody. And that's not good. And if you don't know any payments by anybody, then where's your money laundering? So it's a very difficult
Thank you. Thank you.
Thank you.
Thank you, Chair Powell. Thank you, Madam Chair.
Yeah, Nicholas, you're recognized for 5 minutes.
Thank you, Madam Chair. Good day to you, Chairman Powell. And Andy, your friends are mourning with you, man. I'm deeply sorry for your loss. Madam Chair, I want to first begin by thanking you and the committee for drafting this letter on behalf of the committee that we sent to Secretary Mnuchin and to you, Chairman Powell, dated May 13, 2020, particularly addressing the lack of territorial inclusion in the municipal liquidity facility that's being administered by the Fed. More specifically, we write, through the Coronavirus Aid, Relief, and Economic Securities Act, signed into law on March 27th, Congress instructed the Treasury Secretary to seek the establishment of a facility that would support the market for borrowing by state, municipal, and territorial governments. Despite the clear and unambiguous inclusion of territorial governments in these instructions, the Federal Reserve's Municipal Liquidity Facility, initially announced on April 9th, did not list territories among eligible issuers of debt. Furthermore, despite earlier requests to correct the original announcement, the Fed's subsequent announcement on April 27th significantly expanded the number of eligible issuers that the Municipal Liquidity Facility would support, but continued to exclude territorial governments. Mr. Chairman, earlier in your dialogue with my colleague, Mr. Himes, I quoted you here saying that we're implementing the law that you passed. But the law that we passed in the CARES Act fully includes territories in the Municipal Liquidity Facility, and yet the Fed is excluding territories from being able to access that facility. In response to our letter that we sent to you on May 13th, we got a response 2 days ago on June 15th from you, and the area that you address with respect to that concern, you state, and I quote, "As you know, we are required by law in our emergency lending to be well secured and to protect taxpayers from loss, and we are prohibited from lending to insolvent borrowers. The financial circumstances of the territories are generally inconsistent with these statutory constraints." Now, Mr. Chairman, notwithstanding Puerto Rico's circumstances, Guam is not insolvent. The Commonwealth of the Northern Marianas are not insolvent. American Samoa is not insolvent, and the U.S. Virgin Islands are not insolvent. And so my question is, why are we excluding these territories from being able to access the municipal lending facility?
So as you pointed out, we are, what we put in our letter is really the way the law. We're required to conclude that we're adequately secured, and we have not been able to come to the view that any of the territories would be able to borrow from us, and that there are other government. I don't doubt the need for borrowing, but there are other programs which are better suited to serving the territory's needs.
But the CARES Act specifically authorizes territories to be able to access the municipal liquidity facility. It's very clear in the law, and the rationale for excluding them is not consistent with all of the territories. And I seriously doubt there's some kind of test being administered to every other jurisdiction in the country that's accessing the municipal liquidity facility. So I want to ask if there's going to be any reconsideration from the Fed given all of these facts.
All of the other, to be eligible for the municipal facility, borrowers are required to have an investment grade rating, and all of those who are eligible do have an investment grade rating. That's a requirement we set for the municipal loan facility.
The liquidity facility, though, Mr. Chairman, when we authorized it under the law, we did not set those kind of bars. And one of the reasons why the liquidity facility being accessible by the Fed is because when you have jurisdictions that are having more difficulty accessing capital markets, the reason why we provided those fundings is for the Fed to be able to provide that through the government.
I'm sorry that we disagree on this. I would just say that we're a provider of liquidity, and those are the judgments that we've made. We'll be happy to go back to the drawing board and look again, but that's the judgment that we'd come to in terms of what Section 13.3 under the Federal Reserve Act requires of us.
Just to close, Madam Chair, because in the conversations today we talked about giving minorities more access and taking care of those communities. Our territories have upwards of 90% populations comprised of minorities. We talked about the need for supporting tourism industries. Our tourism industries in our territories are critically strained. We need to be able to access these resources that we're providing. Thank you, Madam Chair. I yield back.
Thank you very much. I'd like to thank Chair Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to Chair Powell for his response. I ask you to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Let me just say that I join with all of you today, all of my colleagues, in sending my prayers and condolences to Andy Barr and his children. Let us keep them in our prayers. This meeting is adjourned.